Yeah, we're actually gonna do range this time because we're broken. So our rental prices are quite high.
Yeah.
Well, I mean, they did.
Yeah.
Check 1, 2, 3, 4.
The breakfast stuff starts at like 8:30.
Oh,
Okay. If we had some.
yeah, I can hear some. Just so you get I wanted to like get there before breakfast.
I wanted some of the raspberries,
you're like,
right?
you camping out since like 7 a.m. just to make sure we're.
I walked down here and
Yes, that's good.
I stopped at like
That's live.
Change words.
Yeah.
I walked in,
Yeah.
and the guy's like,
Yeah, you're like, I'm gonna frame this. This is nice.
so anyway, that was interesting. So yeah, not camping out
Now,
here.
when you're doing a PDF, though, you want to 4 or 5 stories. Right, second.
Right, I think that.
That's what that is.
today we don't have
That's fascinating.
Oh,
Yeah, it's just a different level. I guess it's like our custom readers.
Close it?
Custom coffee level.
That is kind of a whole learning curve.
No, the whole
I
thing.
think what got me out. I was
Okay,
I
so
heard,
you want to
James,
right click,
presentations.
open with,
got me out.
go to the reader.
It was interesting, if nothing else.
I unfortunately.
Did you?
Yeah, so I was
And open the next one.
back, there was home duties.
You said there's 2 today?
The other one's at
Yeah,
our.
it sounds like.
Oh, okay. That one,
We have time.
okay.
So
So let's go ahead and close that.
I thought after you, they like kind of make fun of Dave, but also.
Now we can,
We should do more of that.
It was like, so, like all the members of the whole, like a faculty in the audience developing their own ideas, but then
That sometimes cuts out the,
Yes.
how to
I
get.
can do, view up here.
Well, I don't want to prevent you from meeting. I'll let you get to it.
Okay, actually, I'm gonna grab my phone.
And if you want to, you probably don't need to see the audio. Just do that.
What is something I want to talk?
Let's make sure. Is there a PowerPoint?
Yeah.
Imagine you might do.
Okay.
Here's someone interesting. Problem is, if you were a junior person, that's like, I wouldn't have not read it.
How you doing? Yep, sounds like a baby.
But then, once you do that, when it gets to the renewal decision.
Did you stay until the very end?
Whatever it is.
Yes,
Like,
the
people
end.
being aware.
What time was that? Like,
Oh, yesterday.
Yeah.
No.
I left right after the decision.
okay.
Thanks.
All right.
John gets credit for all things.
It was just like
I know
getting
person.
too long, right? Yeah. I think it's time to go.
Let's just put this way, you ready?
That's good, right? Oh, no.
Actually, I found
It was just too much.
Yeah. Yeah.
Or you introduce folks and
Yeah.
whatever, you can kind of get
Yeah,
that
with the mouse.
But I've sat in enough meetings, if you were to go on.
I feel really bad, yeah.
Not really.
That's fine.
But it's a good
I'm all
point.
rested, so.
I appreciate it.
Establish your own footprint, like even though it's probably.
Sacrifice.
No, I'm live streaming.
They want to.
Oh, good, okay.
Yeah.
I think we're good and,
Do we not want to share the slide until she starts?
yeah, let me ask.
Problem is you can't prove it. You can't prove this.
Hi, Lisa.
I think the inference, I think,
So we've got you all set up.
they see the.
Do you want your presentation on all the screens?
Less senior or equal.
Or yes,
then they-
you want to put it monitor?
You want to see the gallery? Or does it-
Whereas if you're-
You'll hear
They
that.
just infer that you-
Oh,
You
I'm
wanna
Zoom.
see the gallery?
No,
Okay,
I'm
so we just do slides.
Yes,
Okay.
so then we're good.
Okay.
Thank you so
If,
much.
okay, it's an archival paper, for the most part. Get that, it's like plus or minus censorship. If you're in like, yeah, we're trying to hang on to, that's gotta be really tough. You're in market.
I think it's good. I think you're right. Exposing people to the approach and telling them.
I'm still gonna stand by that.
Okay, good morning, everybody. Let's move it down a little bit. Good morning. It's great to see you guys all back in person. I think I thoroughly enjoyed yesterday. And it's also good to see that we're still having people on Zoom on a Saturday morning. Hi, everybody. I have a quick announcement, but before I do the announcement, I wanted to do a quick shout out to all of you because yesterday's discussions, I think, were really good. I think it's the questions, the thoughtful comments, the sort of engaged audience that really make the JAR conference a special event. And so thanks to you for coming on behalf of sort of all the editors and for engaging and being helpful to the authors. Really appreciate it. So with that, let me make one announcement. So when we got the submissions for this year's conference, it made us sort of think a bit more broadly about ESG and the role of accounting. And we got a lot of submissions. We unfortunately couldn't take all of them. But as we sort of all know, ESG has become sort of a major topic. There's some people in the accounting community who have actually worked on this for decades. But for many of us, it's kind of a more recent thing. It certainly has been for me that we've sort of engaged with this. And the topic, there's sort of a lot of issues that I think near and dear to the accountant's heart, right? There's accountability, there's measurement, there's assurance issues, and so on. And in fact, yesterday I had to step out for an alumni event briefly. And one of the participants in that panel or in the discussion was actually noting how he had not seen as much interest in these issues in his entire career before, right? And so as we were sort of thinking about that these issues are here and they're going to be with us for a while, we were thinking that we wanted to sort of signal that we're continued interest having these topics. And so therefore, we're going to have another special issue in JAR on this topic to sort of continue the debate. Because if you think about it, where at the moment in the sort of old climate ESG debate, where there's movement, it seems to be it's on the reporting side, right? So a carbon tax, some kind of carbon pricing seems to be politically not gaining much traction. But where there is traction is actually, you think about the IFRS Foundation, the ISSB, the SEC proposal is on this reporting side. So I think there's a real opportunity for the accountants to play an important role in that debate. And again, to sort of further that, to be part of that, JAR wants to do another special issue. The suggested deadline, it's going to be more of a soft deadline. It's going to be November 1 of this year. And the idea being so that we can kind of have a reasonable chance to have sort of the issue out either late next year or early, in 2024, kind of like the timeline the JAR conference is on. But if you, don't make it by that deadline, because it's obviously kind of close to this date already, we're going to obviously continue to be interested in these type of papers for JAR more generally, and we'll just review them for, regular issues. But again, to sort of signal the interest, we're going to have that extra issue coming up. So with that, let me turn it over to, where is she? Gian and the authors, and present their paper. So thanks again to all of you. And Gian is going to present the paper with Gregory Islahorst on supply chains. Oh, this was already, I thought that it was already announced, but Harash is saying, he's the theorist, but if you guys haven't seen, it's been long out already. There is an announcement for the upcoming JAR conference. No, it's good that you said it. So the upcoming JAR conference is going to be on theory, the role of theory in accounting research. So the idea is not just theory papers, but also can we combine theory with empirical papers, structural work. Sort of basically the idea is that it is a more structured, more theory approach to accounting, but it doesn't have to be, can be empirical papers of sorts. Could be simulations, whatever you have in mind. Did I forget?
That's good. Submit your paper, empirical papers grounded in theory.
That was
all right.
Good.
Thank you.
Thank you.
Okay. Just quickly checking. Okay, thank you very much. First of all, to the JAR editors, to the reviewers, and also for the conference organizers for including this paper into this year's conference. My name is Jian Shin, and I will be presenting this paper, which is joint work together with Greg Distelhorst, who is a colleague of mine at the University of Toronto, and actually not with the accounting unit, but with the strategy unit, and also has an appointment with the Center for Industrial Relations and Human Resources. And I'm very fortunate, really, to be able to collaborate with him on this project, whereby we're using very interesting and unique data, in my opinion, from a multinational organization that sought to make a social impact in its global supply chain by raising factory worker wages. And this work is really motivated by the bulk of research that tries to examine how to enhance firm CSR commitment. And I believe we have a ton of work on this that tries to look at how firm level CSR outcomes are correlated with different institutional factors, how, for example, corporate governance mechanisms can play a role here, as we've seen yesterday in the paper on executive compensation, and also as accountants, importantly, what the role of the corporate information environment could be, and the role of mandatory or voluntary reporting standards. What needs to be mentioned, however, is though also that most of the empirical work, I believe here, is really reliant on firm level CSR metrics that's primarily based on two data sources. First, which is self-initiated firms' CSR reports, and two, third-party data vendors' readily available CSR performance metrics, which is MSCI, Refinitiv, and all these data sources. And recent research, increasingly, however, also documents certain potential limitations with these metrics, and that they might be actually biased by the role of media, and also just inherently firms' incentives, right, to just sort of aggregate or exaggerate their accomplishments when it comes to their CSR outcomes. What we do in this paper is we are not relying on these performance metrics. What we do is to actually use or look at specific investments that were made by a multinational corporation to make CSR impact. And thereby, I believe we're sort of opening the black box to some extent in terms of what CSR performance could actually entail. And importantly, when we talk about corporate social responsibility, right, what the role of corporations actually, or what corporations are actually doing when they say they make a real impact. And by looking at this, we're trying to make an assessment of the effect of the investments that they made, and also to the extent that they were effective, assessed by how much they were effective. Our CSR focus is worker wages in the global garment industry. And it's a widely known fact, really, that violations of international labor standards are widespread across different globalized industries. And the big contentious issue here is really that a lot of accusation is put on these multinational brands that they are in charge of exploiting really the cheap labor, mostly in sweatshop conditions in developing countries. And in response to this, a lot of big brands actually have tried to address this issue by trying to enforce compliance to these sets of minimum standards that are in place. And obviously, in the case for worker wages, it's the legal requirement for minimum wages that are in these local markets in these countries. However, as you can see here in the data, it's also a very widely known fact that just simple compliance with these minimum wages is just not enough to fundamentally enhance the working standards and the living standards of these workers, right? So in most of the countries, the developing countries where these outsourcing activities are happening, the legal minimum wage only comprises a small fraction of the living wage, which is a wage level that's needed in order to sustain a comfortable living of the worker. And in accordance with this trend, actually, there has also been this big push now away just from trying to enforce compliance to these minimum standards to actually fundamentally try to raise the living wage or the wage level of these workers per se. And our multinational corporation, which I'll hereafter refer to as retail, which is also the case in the paper, is no exception this movement. They have expressed a huge commitment of trying to achieve fair living wages in its global supply chain. And how they wanted to achieve this is by primarily implementing 2 wage-related management control interventions at the supplier factories in their global supply chain. This incorporated mainly 2 elements. One being the workplace dialogue program, which was mostly systems centered around or targeting workers' voice and awareness of their rights that they had. So, for example, investments into educating the workers about their rights and also setting up the right systems to get worker representative elections going. And the second important element was the wage management system, which was directly or systems directly targeting the wages per se. So this would be changes in remuneration practices, and importantly, towards the latter part of the wage management system, this would ultimately result in ideally the implementation of a wage grid, which would clearly communicate to all the workers a wage level to which they're entitled to based off of their skill and experience levels. And for, in terms of the implementation, what needs to be noted, I think some important facts here that we have to keep in mind is that these interventions were by no means mandatory. Retail really encouraged a lot of, or exerted a lot of onboarding efforts to these suppliers, and all of suppliers were really encouraged to take part in these initiatives. What also needs to be noted is that the order in which these interventions were implemented were sort of consecutive. Ideally, it started out with the workplace dialogue program, which would then later on roll into the wage management system, because fundamental to this was the belief that the communication that was made possible with the workplace dialogue program would sort of inform the design of the wage management system as well. Yes, I'll take the first question.
To what extent can this be viewed as just a more general quality control initiative? Or the customers worried about the quality of suppliers and things like that, and want to have a little more control over the workers at those plants.
Excuse me, can you repeat the question?
Oh, sorry. So to what extent could this be thought of as a more general quality control initiative? This big customer is worried about the quality of its suppliers and wants to have a little more influence over worker satisfaction and things like that.
In the bigger sort of overarching framework, I guess you could say that it's a quality control if customers are considered about sustainability related aspects, right? But when you look at the actual implementation of what these program elements actually entail, right? As I've said, it's the workplace dialogue program in the supplier factories that tries to initiate the communication around this, and really changes in the remuneration practices with the implementation of these programs.
I've sort of a comment and then a question that's sort of following up on what John is asking. So the comment is the following. I think what's really exciting about the paper to me is that if we think about how activists and NGOs and so on often have thought about changing practices in developing countries, because there is obviously always the issue with ESG of offshoring, is that to what extent does it work to put pressure on the customers in the rich countries? And then does that change anything in the development? And that's kind of where your paper is. And I think I would highlight that a little bit more, because that's a really important mechanism, that if that mechanism works, that we understand it and understand how it works. That then leads to my question, is sort of, we don't talk that much about what pressures retail was facing and why they implemented it. I think John's question was sort of like, maybe there was an internal quality control, but I was wondering, were there external pressures? Like that the why I think is an important part of the paper, especially if you want to link to that broader debate, which I think is good.
Okay, yes, I can speak to it, and definitely I can incorporate the details of it for why retail had these pressures. But from my talk with them. And actually, it's a lot of this public awareness that's stemming from this ethical sourcing practices. And as you said earlier on, with this huge demand for CSR. And what is a matter of fact is also that they are actually considered in this garment industry to be some of the pioneers in implementing all these systems. And actually, I wanted to talk about this later on as well. Potential other effects that this has induced is actually a big pressure on these other big retail brands to follow suit on these practices too. So it really, I have to say, it's spawned by this huge demand for CSR and ethical sourcing practices. And I was fortunate, I think, enough to collaborate with this organization that's considered to be one of the pioneers in trying to implement this in such a large scale in its global supply chain. Yes.
So you say in the paper that this company implemented wage tracking back in 2016. So the company can see what their suppliers are paying in wages.
So the wage data starts in 2012.
So if they can see what's going on, they can control, right? So
They can-
if a company sees what wages the suppliers are paying, it's an easy thing for them to change that.
So you mean just by going enforce higher pay for these?
I mean, there's wage
That's-
tracking at the
yes.
supplier. So if I tell my suppliers pay more wages, then I
Right.
have an information system in place that I can see whether they paid more wages.
I guess that's exactly what they were trying to sort of implement with these wage management systems.
Why
as
do you
well.
need a wage management system? Why would you need work? Once you've got the tracking in place, why?
Because I think a big issue here is also that we're working with different legal entities as well, right? For retail, they're working with supplier factories, and a lot of why this is such a big problem in implementing is when they're trying to get this consent for implementing these programs, a lot of the suppliers would initially push back by saying, okay, for you, I know what's important, right? It's to get a good price, get good quality on your orders. Why does it matter really to you that how we are paying our workers, right? There's no enforcement, so to say, that retail has over the practices that the suppliers are having here, supplier firms. Yes, Charlie, I'll go from here and then over there.
So do you know whether or not the composition of jobs?
Can you speak up a little bit?
Could the composition of jobs change? So if
The composition of jobs?
jobs, yeah. So wages can go up, but it may be like it's going on at the same time as mechanization. So we're now, there's a different kind of job that we're paying for, which is going to be higher wages in general. Do you see other parts of like changes in the type of work that's being done?
That is possible, and we would love to explore that honestly, but I have to say with these potential other effects that we were talking about here, we were very limited in terms of data. So maybe I can go quickly, just sort of a preview of the findings here, the non-wage effects. I'd just like to highlight here, other than the wage effects, what we are addressing is what we can empirically examine and have data on is the number of orders that the factories receive from retail subsequent to these interventions. We see an increase on that. So that's a non-wage related effect. Another aspect that's not currently included in the manuscript that was circulated because the data is only limited to the latter half of the sample is the number of workers that we have in the data. And at least we're seeing for that sample, there's no decline in the workforce, which to us was a little bit comforting because there's no, in essence, it's telling there's no layoffs in order to compensate for this. Maybe I can go, yes, questions to us?
Yeah, related to that, so I think the fact that wages increase per se, right, because labor essentially is a labor supply kind of shifter. So I think the composition of the workforce should, change. And I think a big issue in that context is also child labor, right? It's like, I was just looking at on the website of Human Rights Watch, for example, right, that they are really tracking, the labor conditions of children in particular, right? So to the extent that increased wages could, potentially, hopefully see that, some children, stay at home and, go to school, and there's kind of substitution of kind of older, kind of more higher skilled individuals. And then related to that, I think it would be fascinating in that setting to maybe tease out a little bit more the local development effects of this intervention, right? So I think in that literature, by now I think we've kind of seen that interventions like this work pretty well at the firm level in changing kind of corporate practices, but also more generally, a key question is to which extent does it then spill over, right, to other firms, or what does it do to the local economy to kind of multiply or amplify the effects of this intervention, hopefully as much as possible, because then development becomes more sustainable and more widespread, right?
Right.
So I think so maybe one avenue, maybe it's a different paper, but one avenue could be to use kind of, so this is what Hans Mark and I have been doing in our Africa paper. There's actually very cool geolocated survey data, also in some of your countries, where you can actually track the household based on where they're located, and then you can kind of plausibly maybe link it to a factory. You have 1,800 factories, right? So to the extent that then in these data sets, you will be able to observe, do the children go to school, right? Do they work? What's the household income? So that could allow you to kind of measure this below.
Right.
And similarly, or you use the classic kind of nine measures, right, to measure economic activity more generally. And then there's also economic kind of census lists of firms that we quickly mentioned about yesterday, where you could really, I think you could measure the spillovers horizontally too.
Right. I would
Others
love to
try
do
it.
that really with the additional data that we could pull off of this. But the reason why, I guess I personally believe it's material for a different set of, for a different paper, because, and this I think is a good segue into actually the research question, which I think is whether the management control interventions would be effective or not at the supplier factories. And I think there's significant tension already around this. We have established, I think, that the answer to this is yes, they can be effective. So yes, I would like to entertain potential other areas there too. Yes, Anna?
So I think this is a great slide for my question. So I struggled a little bit with what the big picture research question is here. So you say many times, we don't know whether like inter-firm controls can sort of be effective. And I don't know if I agree with that. I think we have ample evidence about supply chain relationships and contracting environments and how that controls behaviors between firms. So I'm wondering what your research question is. Is it about the effectiveness of agreements between firms in the supply chain in the presence of perhaps weak institutions or something like that? Or is it specifically about these particular initiatives, and those are somehow different than other conflicts of interest?
So yes, I think specifically the research question that we're after here is whether these interventions to increase wages, right, at different legal entities, which is the supplier firms in our setting, can be effective in making an impact on these social outcomes, these wages specifically. And I think, again, to provide a little bit of context here, I think there is significant tension around this management control intervention specifically, because there's a lot of research on, for example, compliance-based system, right? Compliance-based systems, as I've said, right? Complying with checking off of the list of just a certain set of minimum standards. And a lot of, I guess, enforcement has been on those set of standards. And we know actually from practice as well that this in itself, just focusing on these legal standards in a lot of cases was not effective. We don't see 100% compliance. Then with this, what we actually expect to see supplier firms wanting to go beyond this as well, to raise worker wages. And I think this is in itself a very contentious question for which we do not really know the answer to.
Let me ask the question differently. I think what Anna was getting at is the following. Imagine this was a cost control intervention. Would you still say that we have very little knowledge whether cost control in supply chains that there would be effects, or would you say at that point we kind of know?
I think there's limited control interventions with respect to the management practices at supplier firms. Because when we look at the contracts really, or at least in the sense for retail, what I know, they don't have specific, like what we are usually used to when we look at executive compensation or contracts, things like that, like covenants or detailed performance metrics. It's usually matters around the orders, around price deals, and not also most of the times for a very long term. It's just for the next fashion cycle or the next business cycle, right?
That's what I meant. So cost control or wages or stuff, you would probably say that's something people have looked at.
Yeah.
So I think in part what Anna's getting at is like to highlight and think about what is special about this intervention and how that also connects with, I think, some of the ESG issues
Yes.
is what presumably makes this different from
Right.
the other stuff. And I think
Yes.
she was asking to bring that out a bit
I see.
more, because that I think is critical to the paper.
Yes. And then
Attribution or uniqueness of it, right?
I think then I would say, yes, there is, and actually it's also revealed in some of the data that we're using, right? Because we have SRM system data or supplier rating system data where retail tries to evaluate the performance of their suppliers, right? Based off of certain price-related metrics or quantity order-related metrics. And sustainability is one of the standards there as well. And I guess for this management control intervention, it's very unique and specific that the interventions were specifically around the social outcome, which I don't think in the literature has been examined really before. Yes. Becky.
So I was really intrigued at the result that you're finding there in the worst suppliers. Like the worst suppliers, like where you say here, that are lower rated suppliers is where you find the effects are the greatest. And I wanted to know a little bit more about this, and I think you call it cooperative exchange. I mean, I interpreted the fact that the increase in orders went up as kind of like, look, if you can do this, you can increase wages. So we retail can talk about kind of increased wages that we're doing, that we're going to buy more from you, as more kind of like a do this so that we can get some other added benefits.
So
I view it almost like a quid pro quo, in the sense that, like, you know, the supplier or the retail is forcing these lower rated suppliers to improve. They have the most to improve, and then they get more orders because they've improved. But what I wanted to know is, like, actually at these factories, are other conditions improving? You know, are they just saying, fine, we'll pay more wages because we can get more, you know, orders in the door, but actually the factory conditions are still terrible? I mean, is it wages do go up, but are there other things that you can talk about with the you know, at the supplier locations, other metrics that you can use to actually evaluate, like, overall, are these lower rated suppliers actually becoming better places to work at, better conditions? Or is this just the way that the manager in the local country is getting more orders in the door, which he or she might be compensated on?
I see. Yes, again, this, I think I would have to answer with just basically qualitative evidence and anecdotal evidence that we have. So what I can say is that actually a lot of the onboarding efforts, right, that were made by retail to get a lot of consent from the suppliers is by committing with business, right? So they were saying that, okay, if you are entrepreneurial enough, right, to say yes to the interventions that we're doing, we're willing to stay with you and at least are not decreasing the orders. That's what we can promise you. And actually they said, I thought it was pretty intriguing that for the meetings that they had with the suppliers to get the consent, it was for that reason very important to have the business manager in those meetings too, so that it sent a credible signal out there to the suppliers that really orders would not decrease. So I would actually, the increase in orders result is, I think, evidence that retail followed up with their promise subsequent to the effect that they saw in the wages. So that's one detail I think that I can provide here. And with respect to the other potential effects, actually, again, just anecdotally, what I can say, and it's also consistent with, I think, the overarching aim of these programs is that it really tried to enhance transparency and communication around wage management practices within the supplier firms in general. And what we hear is that this had potentially spillover effects also in other HR practices, such as promotion decisions and hiring decisions. And we hear that it potentially has led to greater, worker satisfaction. And actually there is quite empirical evidence also in the field that shows how enhanced pay systems lead to worker productivity. We cannot test that here in our data because we do not have data on worker productivity or these other areas, but I think pretty much the results that we hear that we could gather are in line with what we have in the prior literature, those two. And I would say I would be less, yes, at least the anecdotal evidence didn't speak to that.
Right. I mean, I guess the last comment I would say is, I mean, the way you present it on the slide and the way it's written in the paper is like this increase in orders is like this positive outcome, which certainly, could be the case. But to me, I almost view it as a determinant of why the wages went up in the first place, because it's like this agreement, like we're gonna send more business your way, do this. And so I wanted to see other outcomes, recognizing that you're limited in what you can do, but perhaps talking more about this literature you were just referring to, maybe even bringing in some of the anecdotal evidence to the extent that you can about some of these other positive benefits would be helpful to really reinforce that this is indeed a positive outcome, not just a determinant of the effect you find.
Okay, thank you very much. Yes?
There seems to be something that's economically troubling about a story where you have an intervention that causes wage costs to go up. And as a consequence, you're going to buy more. So ordinarily you would buy less if cost goes up. And what seems missing in the story is what the real cost is to retail. I know you've got a bullet on this slide that says it's highly cost effective for retail. I think that's referring to the cost of implementing the programs, the cost of implementing the interventions, which works out to $1.62 per worker. It's cheap.
Yeah.
But what needed to complete the story for me is, are there increases in the supplier's cost to retail? Presumably, the supplier is not eating 100% of these wage increases, but that's the implication of the paper, that the supplier is eating all the costs and the retail is getting all the benefits. But if the cost to supplier goes up in a competitive market, some of that would be passed on to retail and ultimately to consumers. We're going to pay more for clothes. And I don't want to sound callous. It may all be worth it. I'm all for ethical sourcing. But at the end of the day, this seems to be a cost-benefit trade-off question without any indication of the cost. Is retail paying more for clothes and materials than the suppliers thanks to these interventions?
Yes, yes, I agree with that. That might be a possibility. Again, I would just have to say that we don't have really margin or anything sort of data, but around that. But I think and we do something in the paper where we sort of address these potential possibilities. I think I would like to pull it back to the empirical evidence that we are able to show here, which is some redistribution effect that we're seeing whereby workers are gaining because the frontline workers are really seeing increases in wages. Who is absorbing the cost is a big question. As you said, right? It could be consumers that are absorbing these costs. It could be suppliers, managements that are absorbing part of these costs too. It could be even other retailers that are absorbing part of these costs too. I think this is great fruit for additional research. But again, I think what we are able to show is at least certain stakeholders, which in our case, the CSR or the social impact outcome that we were after, workers were able to at least saw some gains from these interventions.
I'd encourage you to back off bullets like the one on this slide, highly cost effective for retail. You don't really know whether it's highly cost effective for retail. The cost of implementing the programs is the tip of the iceberg, potentially at least. The real cost might be the cost of higher supplier costs and maybe less demand from consumers, just the trade-offs of, let's put it this way, they're sourcing from developing countries for a reason. And to deny that reason, which is fundamentally low cost, seems to be at least a oversimplified story. Again, I don't want to sound callous. It may all be worth it. I'm all for ethical sourcing. I'm all for I don't want to suggest otherwise, but there's a cost of that, and that cost seems to be ignored.
Right. Just to the clarification of what we meant here by cost effective is just, okay, assuming that, I guess, retail has this objective of wanting to raise wages, cost effective is relative to the benchmark of, okay, what would have happened if retail, instead of investing the same resources in these systems, what would have happened, the hypothetical scenario, if they would have just paid out the same amount of money to the affected workers. And in that sense, we are saying it was cost effective. But, and again, I agree with you that we're not able to consider all the potential, also alternative, I guess, opportunity costs that are associated with different
It's not opportunity costs, it's just you're paying more for clothes.
Yes. Thank you very much.
Yeah, I wanted to go back to because when I read the paper, I thought it's a nice setting and it's a nice study. And I was trying to think about sort of how we generalize from it. And then you said that there's plausible tension, right? Other studies sort of not documented. And so you can sort of show an effect here, right? And can you speak to sort of why you think you would be able to find an effect here where you might not be able to find it in another setting? It's a little bit unfair because you have like sort of one observation at some level.
Yes.
It seems like that's kind of crucial to sort of thinking about
Right.
what you learn more generally.
Yes, I acknowledge the generalizability concern, but I think also a very big fact is that we are working with this supply chain configuration in most of these settings. And it's the case really, and I think a big driving force for why I personally think big driving force for why these interventions can be effective is first of all, because retail has potentially a lot of bargaining power in these relationships, right? As well, potentially. And we are not able currently to, because we're limited in the data, this would also require to see sort of the business that these factories have with other bigger major retail brands as well. We do not have data on that, so we cannot potentially run tests to examine those. But if you ask me, this is potentially a driving force here.
Do you think it's sort of a market power kind of, if you're big enough and powerful?
I would love to explore that. Rachel?
I also have a little bit of different ways. Often when you have like targeted programs that work, there's a question of would they be scalable? And so what are your thoughts of the scalability of your proposal?
The scalability meaning generalizability, in other words?
Often with programs are specifically easier to implement when you are implementing them in less places. And so therefore they become less effective and more costly. The more places you are trying to implement a specific program.
Yes, again, I think to me, the way I understood your question is similar to the general reliability concern, right? It's in what other contexts can this be made as well? Again, I think I would have to defer to my last answer that we are very limited in terms of the data to look at potential factors that could explain in what circumstances that this might or might not work. And I think it's good for future research, actually. I would love to have additional data to explore that. John?
Yeah, so I think at Steve's point, there is a social premium, right? So firms make these investments, they can charge higher prices. We're willing to pay more for Starbucks coffee than generic coffee because it's socially sourced or whatever, fair trade. I don't mean air quotes. But apart from that, like, I hate to be like the negative person, but let me give you kind of an alternative story here because I remember there these, and you refer to it in your paper, these social audits. Like Ericsson was one of the first companies that was trying to do these social audits, and there's like a great documentary of how they go in and they're shown like the second pair of books. So back to an accounting angle, I know this wage system is reporting from the firms that they go and look at the books, but they could have two pair of books. And so here's a nefarious story where you have a firm that wants to charge more for their prices, so they want to have a social supply chain. And then you have factories that are willing to show you their books and show you that their reported wages are higher because are they audited?
Yes, so there are social audits.
Yeah, no, but the actual books that are being showed,
Yeah.
if you look at this documentary, they had like two pairs of books, like the actual wages that they were paying the employees and what they were showing Ericsson that they were paying and they were doing. And it's very kind of sincere and well, it's kind of interesting that it's in the worst suppliers, which you would imagine would be also the ones more likely to have two pairs of books that would be reporting these higher wages, no worker turnover, and you get like a win-win, right? But there's nothing really being improvement. I know you have the anecdotal, so I'm
Right.
like, coming back to, I think Becky's point, if you had like surveys from the actual employees, like are the actual working conditions improving, or is this just kind of like greenwashing or social washing where reported wages are going up, win-win, these implemented programs are good, the firm feels good, charges higher prices, does more orders, yet the workers are the ones being.
Yes, again, we'll try, I think, our best to incorporate a lot of these additional evidence, or at least based off of the anecdotal evidence that we have so far, to incorporate that into the paper as well. But I have to speak to the exceptional, I think, some of the huge efforts that went into actually going and collecting the wages and trying to implement the right management controls.
Ericsson was doing that too, right? So there are cases where these firms were sending like teams in, right? And like, it's still fraud, right? There's the same amount of effort that does in an audit and we still see fraud. And especially in these low institutional countries where it's less clear. So I'm just trying to like at least be a little bit more conservative because you don't really talk that much about the wage system, just saying, oh, they sent people in and they looked at the books. But there could be two pairs of books.
Right. So part of it is like a lot of these factories, they pay through cash, right? Daily basis. So that is cash is very fungible.
Mm.
That's what makes it difficult. Really. John's point.
Right.
Let's get one question from the Zoom audience. Stephen, you have your hand up.
So I actually wanted to go back to something Christian said and maybe like more of the motivation for the study. One of the arguments for accomplishing social responsibility goals through the corporation is that the corporation can affect outcomes that individuals or like the government can't, right? So I'm wondering if you can kind of talk to this, going back to the motivation for your study, if your study can speak to, why CSR, why through the corporation specifically, why isn't this a goal that like the US government or individuals as shareholders could accomplish privately? And I think you can. I wonder if you can sort of lean more into that motivation.
Yeah, I think this is a great, question that sort of brings up the huge problems in this industry partly as well, right? There is in these developing countries, especially where a lot of these activities are happening, there is weak institutions by which it's hard to instill all of these in a regulatory fashion. For example, increasing minimum wages, where there would be a strong, there would be a government that would really care about those. This is in essence hard to attain in a lot of the countries that we're working with here. And in that sense, I think the initiatives that we're looking at here, it's in some sense like private regulators, right? We have these big corporate multinationals going in that are willing to invest in diffusing their developed management practices. And this is sort of one way by which I think it's a great motivation for why what corporations can actually do here in this context. Yes.
An alternative interpretation of the intervention is that the retail has a lot of bargaining power. So if you have all the bargaining power and you know the cost structure of the supplier, then you can essentially put them at zero profit. And that might have nothing to do with CSR, because your interest as someone who has all the bargaining power is to know everything and then price them to zero. And I'm kind of struggling to understand if was done only to protect employees or if there is a business reason. And what goes to this explanation is you find no evidence that the supplier was compensated just like Steve was suggesting. So you don't see any higher prices. Everything is being paid by the supplier. And so is there a very rational, simple reason that what essentially retail was doing is forcing them to reveal private information? And when they do that, then of course it's over. They cannot make any excess profits.
Yes, actually, I think, again, this is going back to my knowledge from the field a little bit. So a lot of these suppliers that consented, right, to these interventions, a lot of their motivation actually was stemming from the fact that they think that the industry for their whole country, as primarily being an industry that's outsourcing to these multinationals, is really resting on the business that they're getting here. And given the condition where the big corporations are, right, caring for CSR and really trying to do something better for the workers, they're actually also keen on implementing the right systems that would make that happen. And in that sense, a lot of the big consent from the early adopters, from the suppliers that took part of this, were managers of these supplier firms that had this entrepreneurial mindset in some sense. So I do think that there is incentive also for supplier firms given that the long run, I guess, trend in this industry is going towards CSR and making sure that their workers are ethically being treated. This because they know that this is the way that they can survive in this equilibrium as well.
Jeremy, what I don't understand about your story though, is why would the wages go up? I mean, I understand why information would allow you to maybe drive a harder bargain, but why do wages go up?
Well, that's a good question. So in terms of, once you know the cost structure of your supplier, then it's a good question. So I understand that point. But when you have transparency on the wages, it's going to be a change in bargaining power between supplier and wage earners. I think that's going to benefit the wage earners. But what I would have expected is just, as we were saying, the supplier, the retailer would be giving a little bit more funds to the supplier, and we're not seeing any of it. So it seems that the suppliers are losing out of the deal. They're the one paying for the extra wages.
We don't know though, right? I mean, it's not tested. There's no measurement of cost of. So I mean, you can't say it's all, it's just not tested.
Yeah, you have to also.
Oh, yes. Yeah.
Henry,
Wanted to
four
make sure.
more and.
I think I was already covering the major findings and yes.
So go ahead if you want to keep going.
No, you.
Yes.
So
Just after that, we should go.
quick question is like, why not look at total wage, like wage, base wage and overtime wage? Because I could see some sort of substitution between the two. Have you thought about that? And the other thing that I was thinking about is like, do you have any data on hours worked? Are the employees working less, but getting paid a little bit more, but overall they're worse off because they're not bringing as much home? Do you have any information
So
on that?
hours, I don't think we have currently, so that's an easy one to answer here. But the intervention was around base wages, and that's the reason also why we're looking at that.
But you could see, like, for example, them saying, okay, well, no overtime, you know, you're not going to be paid a little bit extra during those hours. We'll just instead boost your base wage. And then overall, the employees are worse off.
Yeah.
So I guess for me, like, you know, this is the ESG sort of angle, like, you know, we're trying to help these employees. Like, can we rule out this story that they're actually worse off by boosting base wage?
Right. Yes, that's something that we cannot establish here with the data yet, but yes, thank you very much for the comment. I think before I move, there's one question. So I think I've
It's really just building on this. I think so started out the session by like, there's a lot for accountants to add. And I think some of it's like, it seems like there's a lot of interest in what are potentially unintended consequences of if you measure wages or however wages are measured, if you measure them, you know, does that actually lead to an improvement in welfare for the employees? So I think it would be helpful, even if you just added some of your anecdotal experience from the field, but like one concern above and beyond like substitution between base and overtime, I worry about the allocation of work. So like I don't know if factory workers in some sense buy their jobs, like turnover seems to be a very serious problem. And then the difference between what might be called a gross versus a net wage, so how much you have to buy stuff from the employer.
Yes, and I think I love all these comments because it really speaks to the big role that we as accountants can actually be doing here in this sphere. Because I mean, if you think about it, there wasn't even a measurement for wages to begin with, right? And there's a huge effort in doing this. This is what we're doing. And I think it's all speaking to what additional things we can do to actually have a better picture of what's going on. With this, I think I would like to move on a little bit into the research setting again, a little bit of a clarification, just graphically what we're looking at here, right? So the classical or the typical configuration of how things work here is that we have retail, which is the buyer firm, and they have direct monitoring relationships over the factories. And again, for the interventions that we're specifically talking about here, those were implemented at the factory level. An important sort of agent here also is the suppliers. In the paper, they're referred to suppliers. I'm referring them here in the slide as supplier groups because effectively how you can think about them is sets of factories, right? So the business deals, sort of the financial related aspects, those are being negotiated with the suppliers. And then the actual production is happening at these factories. So when later we look at the cross-sectional tests, right, where we use the SRM system that evaluates supplier performance, this performance refers to the supplier's performance, which could be sets of factories. And in our data, it's usually the case that it can span from one, usually up 2 to 3 factories per supplier. But in some cases, in a very handful of cases, we also have factories that suppliers that have 10 factories.
Just clarifying question, just my understanding, at least for me, grew up in a city where this is the predominant work, and the factories often supply to multiple suppliers, multiple retailers.
Yes,
So
that's the case, yes.
if this intervention is one place, what does that mean for the supplier groups that caters to 5 different places? Because it's hard to believe that they would voluntarily increase wages for everyone.
That's such a great question. And I would love to actually exactly look at that question subsequently if I would get hands-on to the data, because my big hypothesis here is actually if these interventions were successful in raising these labor costs, right, this could potentially also lead to transferring these costs to the other big retailers that are also doing business, right, with the factories. And this could potentially speak to, right, also those other big national or big multinational brands also absorbing part of the cost that was implemented from the wage interventions that was implemented by this. But yes, that's a classical configuration. We do not have the data other than the business with retail here in this context. So that's not something that we can look at, but I think that could be something that is going on.
Your concern was more the other direction, that if there's lots of other people, they could switch, and therefore
That
wouldn't be as much of a wage.
It would not be. But then this again ties back to initially what John said, where if you see large increases in wages, then maybe they're reducing their overtime, or maybe there's this other thing going on, which I understand the measurement of that.
Okay, so a brief depiction of the data that we have, which is the wage outcome variable, the social outcome variable that we are after here. We're plotting here the average factory wages across mainly the 9 different markets in which retail is operating in terms of their supply chain. And we see huge variation in terms of not only the wage level, but also in terms of the trends. And this leads us to really try to control the best as we can for the macroeconomic shocks in each of these different markets. Consistent also with the anecdotal evidence of how the programs were designed, right? We start, most of the factories are starting with the implementation of the workplace dialogue program, which would then roll into the wage management system. And this is also seen graphically here in the implementation pattern of these.
Can you speak to your role in the intervention? So my concern is related to Mark's comment earlier in the sense that there's a company that decided to do this intervention and it was successful. So you have an N of 1, but you also have an N of 1 that was successful. And so if they weren't successful, would have you still gotten access to all of this data and been able to see what would have happened under the null?
That's a fair question. I guess I cannot fully talk about, yes. But what I can say is that a lot of the reasons why they wanted to collaborate with us is because a lot of my work personally is involved with trying to make an impact analysis of the interventions that are currently going on, that firms are currently undergoing, right? So doing sort of good causal inference of whether interventions are effective is actually a big sort of question mark for a lot of the firms that are implementing these things. So they were actually wanting to get the answer to what extent their interventions were effective. They wanted to have this economic magnitude, or what they call quote unquote ROI, return on investment of their cost implementation. They wanted to have an answer for this. And that's actually also why we're trying to do a good job in the calibration of the wage effects here, given the wage data they had implemented. And then actually to say they were not really happy to see our results, because if in some sense, if you look at the wage effect, right, it's a 5% increase when I've shown you in the earlier data. I mean, we can put this, I mean, it's 50, it's reasonable, but it could be nicer if it would be larger too, but that's the effect size.
So maybe my last question was fair. This one's going to be unfair then. So did they come to you and say, would you analyze our data? And again, I'm just trying to get a sense of you put up a slide earlier with all the other papers that Rick Locke was involved with. He was a colleague of mine at MIT that didn't find results where I think he was actively involved in putting the intervention in these companies. And so I just want to get a sense of, is this like you went to this company and said, hey, are you doing anything in this space? Or did this company to you and say, hey, we did something in this space and we found some stuff and we would like you to analyze it? Because I do think that affects your ability to generalize and say, well, this is what would happen if other companies did something similar.
So I can tell you, I got aware of this because I got to know my co-author who was sitting in the audience when I was presenting some of my papers. And that's how I got to talk to him. And I was interested in actually doing a study on this to analyze the impacts. And I'm still, up to this point, I'm still persuading him that this is an accounting paper, that we can actually write a paper on this. And yes, that's what I can tell you about the story, how this paper came about.
I'm sorry. A co-author running this study? I'm a little, like, your co-author was
My
running.
co-author has relations, he has a degree in political science, so he has work in the sphere around workers' rights. So he has also,
Firm, the retail firm, like,
not directly with the retail firm. So he's also a researcher,
so who contacted the retail firm?
my co-author.
Okay.
Yes?
So I have a question that's sort of related to John's earlier question. So can you talk a little bit more about, how the firm enforces the supply, like the wage agreement? In particular, I was very curious about like your earlier statement that the commitment to more order flows of work. But for the commitment to work, you have to have a credible threat. So do you have any evidence that if the supplier did not really increase wage or did not improve work conditions? I know you have the data, but if they just violate this sort of implicit agreement, do the firm sort of disengage with supplier, or is there any sort of punishment to the supplier if they fail to increase?
There's none. It was voluntary, as I've said, right? So how it looks like, it's trying to get consent on onboarding for these programs, and literally what the suppliers would be due to sign a commitment agreement that they would be part of the programs. But there is no sort of financial or any order related aspects that the repercussions that they would have for not doing this.
So just to clarify, so if I am a supplier and I just don't increase wage, what's going to happen?
So the implicit threat, I guess, is that they're going to lose business, which is probably why which is the huge incentive for why they will want to be part of these programs. And again, this is the reason I think why I think the effectiveness of this rests on this notion of a collaborative exchange where, yes, if I agree to be part of the programs to increase wages, we'll reward you with the commitment that we have promised you to begin with.
I think that would be super interesting to look at if they do this. That's sort of an important mechanism.
It's like a zero sum. Do you know that? Do you know that the ones that decided not to volunteer, do they get less business?
We're not.
The firm didn't, because it seems like it's very critical for your mechanism about this commitment.
We are seeing that they get more, right?
Yeah, but you could have, sales could be going up, demand could be up for the firm, they're allocating more to the new ones, they're still allocating the same amount, so that wasn't really a credible threat then.
Okay,
The credible threat requires less.
we can try to look at that. Yes?
Just follow up to the point, like this issue of the self-selection, like the Joe's bring is a threat because you have one data point, right? So that the success reflects. So I guess, how do you get around this? Can you almost like put less emphasis on the 5%, but explore more the within sample variation? So the selection exists, your successful treatment, you can't do anything about it. But yeah, like certain factors that are the ones, location, country, or like say, can you almost like leave the average result out, but calibrate within that selection and put more emphasis in the within sample results that you can exploit?
Yes, and that's, I think, the reason why, for me personally, the results on the magnifying effect of the interventions per se were pretty interesting. So we were able to estimate an effect that is far greater than when the resources would have been invested, the direct resources here again, would have been invested in just directly paying it out to the workers. And
And just a clarification, I think the selection effect of the company, if they had a sense that this was a horrible program, and therefore would never come, that one, I don't think we can do anything about. But are you also worried about the selection of the participating?
No, I mean, it's related to many of the comments. First, they said, well, if it wasn't successful, you didn't see. Then my thought was, well, go to Anna's point and think of the effectiveness, not so much if it works or not. But the selection is correlated with the effectiveness. Like, so I was like, how are you going to get around this problem? But within that selection, I don't know if they could control the factor in Indonesia versus Cambodia. And certain, like say, there are within that treatment that you have, there is variation, and exploiting that variation might allow you to say, I can deal with the average, but I can deal with the variance.
The reason I'm asking is it's very similar to like, think about like when we study IFRS or whatever, right? Typically, countries have thought about why they're going to implement that. So a lot of times these things are also selected. You can still study the treatments effectiveness. There's going to be treatment effects on the treated, but we can still learn from those to some extent. And I agree with your point about like the heterogeneity might be even more interesting.
Especially because Joe might say, well, you can't generalize the 5%, it's driven by the selection, but you can still learn a lot from the within sample variation in terms of potential generalization.
yes.
It'd be good to know what happened to worker productivity, because you have this 17 whatever increase.
Can you speak up a little bit? Sorry.
To know what happened to worker productivity. So we know that the hourly wage went up, but we don't know what happened to how much money do they get per shoe made. So to see, especially when it comes to worker quality of life, that they say we're paying you 5% more, but you need to make 20% more shoes. So if you get data on that, that would be a nice.
Yes.
And that would also give some information on what happens to the buyer, the factory owners.
Right.
As if, even if they're paying wages more, they're paying the higher hourly wages if they're getting more output.
These are, yeah, all great comments. Again, I think I can get back to my side with saying that you should put all these additional measures into your monitoring system to actually really get a full picture of what's happening. But again, currently in this study, we're limited with all these other measures. Okay, so I think here I would like to go on to.
This is a dangerous spot.
Oh, okay. Careful research design part. Where I'm showing you here the model. So it's pretty simple. We have as our outcome variable the natural log of the factory wages, which we just, by the way, to compare it across different countries for exchange rate differences and inflation rates. But we also replicated this with just using the raw local currencies, and our effects are pretty much similar. We control for country times year fixed effects and factory fixed effects, and our main indicator variable here is this any program indicator. Again, because the data structure allows us to model everything together, we can do that, which I will also show you. But for the main inferences, we're relying on these any wage program indicator. Okay, just briefly, yes, results here.
Relates to something you said a little while earlier, and you say that quite easily in the paper on how direct commitment of resources to increasing wages at the supplier is not as effective as these programs.
Yeah.
So this is, this result is in developmental economics. So Esther Duflo's Nobel Prize winning research actually says that direct programs do not work as well as improving the quality of the school if it comes to increasing school attendance and all that in local communities. And going back to the points that were raised earlier, you're veering close to some of those developmental economics type arguments. And it might make sense for you to bring that literature in more.
Oh, yes, I would love to cite that work, which I think is
because
consistent.
our finding was that if you
with
give
finding,
books
yes.
to students and if you ask students to stay in school, and you spend on that, the effects would not be as good as improving the system by which administrators and teachers are teaching and administering schools. So, this was not original in and of itself, the whole idea. It's been in developmental economics for a while.
Yeah.
So you might want to take a look at it.
Thank you very much. Brendan?
Do you see the supplier ratings in time series?
Yes.
And do you see the inputs to the supplier ratings?
The
You say
inputs- so
here
these
there's
are
like overall
scores.
quality performance.
Because these are scores that were in essence assigned to by retail to these suppliers.
Okay, but so are the scores developed out of this kind of overall quality performance, overall logistics performance,
Yeah.
et cetera? Can you see those inputs?
Those inputs right now, the data set that we have, no, but I'm assuming that there is, but it's really just a performance evaluation score that's ranging from 0 to 100.
If you can see those in time series and see the inputs, you might be able to do something that like Judson was asking about, like, oh, there is actually improvements in quality, or thus maybe productivity isn't changing somehow or something. Just
So before we go to the results, so the selection and the treatment here, you can do very little about, but the time, obviously, because of the staggering that you have, what's key to your identification is the timing, and you don't tell us a whole lot about what determines the timing. So maybe you can talk a little bit more about that later in the paper as well, but maybe even now explain a little bit exactly how that worked, because that's going to be key to your identification, right? If that timing is endogenous to any kind of trends in wages anyhow, then you can't interpret these anymore as sort of causal effects the way you were saying you want to do for the retail.
So I can tell you what I know, and maybe there are some tests that we can do to explore this, but it's really the staggered timing implementation really stemmed from, first of all, business operational and resource related reasons, right? So implementing this required a lot of costs, and implementing them all at the same time, right? There's staff members involved in this, so that was a huge factor to that. And also, obviously, the difference of the timing, the lag by which they could get the consent from the suppliers, right? It's all happening in essence, starting when they consent, when the suppliers show consent. And for that, so I was asking, okay, why do you think you see consent from some suppliers early on and from some like later on? And again, the whole reason was they refer to the management that had a relatively more open mindset. Again, here retail was an entrepreneur in implementing these, and for the suppliers that was a lot of uncertainty on their part. So it was mostly young management that saw a vision of going with this in their industry, in their country, and that's where they could get the consent. And once actually some suppliers onboarded, which was mostly the young management, which had this vision, it was relatively easier to also get the consent from these other suppliers who would be in these
I
local.
think it would be useful if you had, I don't know whether you can provide statistics and what the timing would be correlated with, but you understand that if, for instance, it is that management was about to do a wage raise, and then we're like, oh, we're going to go along with that, and it's going to give us some kudos with retail, then this is no longer going to be causal, right? So in that sense, I think understanding that mechanism is going to be very important. And also back to Nemit's earlier point, if you had information on what the local competitive situation was, if they are implementing this more in regions or areas where there's either more or less competition, could also be important in terms of understanding.
Yes, I can see what I can do maybe with geographical information that we have, but currently we're, yes, limited, I think, in terms of the geographics, they're a little bit too.
Maybe it'll be also interesting. In all of these factories, of course, there's some employees that are well paid and some that are not well paid, right? So the way this will ideally happen is that some of the lowest paid employees will move more to the average wage. And overall, the mean may increase. But you want to also look at how the distribution of wages changes within that factory, right? Because how is the mean increment happening? Are you bringing the lowest employee to the medium level, or everybody in the factory is going to get a raise?
That's a good comment. And again, I just have to say that we're limited to get the full spectrum of data.
No, but can you go back to the company and ask, how did this happen?
How
do
did
you
this
think,
happen?
how does a company think that the suppliers are doing this? Are they giving everybody a bonus? Or are they just avoiding the lowest paid jobs? Like I've been the auditor of companies like this that manufacture for American brands.
Yeah, and I can just say that there are additional data collection efforts for that reason going in place for those things as well. That's a huge reason also why they invested a lot of resources in having the computerized systems in place to get this on speed for like managing a lot of data, especially also the entire workforce that would allow them to have.
And how do they expect this to happen? Like I tell you, in this particular, I actually audited a maquiladora that used to do that for an American brand. And in this company, there will be workers that will make a decent living that had the most skilled jobs, right? The ones that you call them, some of the people that sewn the pants for a brand new company. And the lowest paid employees were the ones that clean up at the end of the day. Or where jobs that are very bad and very bad conditions. They clean, for example, the baths where they have chemicals. And those are the lowest paid employees. So ideally, those are the ones that are gonna be either eliminated or going off to the mean, right? Not that everyone will get a bonus.
Thank you very much.
Two very good points. So first, just related to what Stephen said earlier, right? How this intervention passes through to prices in retail.
Can you speak up a little bit? Sorry.
Yeah, so regarding that point by Stephen, how this intervention would feed through kind of prices in retail. So probably your company will also, have stores very likely, I guess, in the US, right?
Yeah.
I think you could potentially test this using one of the marketing kind of product scanner data sets, right? Where you could actually come up with a pretty, I guess, nice design, because you obviously know which retailer you're working with, right? So you could, I think, before or after the intervention, essentially, look at kind of changes in pricing relative to the competitors, right?
Yes, maybe I have to think through it a little bit again, but then you would only have data, you wouldn't have a panel really, right? Or would you?
No, but I mean, these data sets typically have point on sale kind of
Because
data
you
with.
have sales data from this one company, which is in the financial statements, right? That they
Sure.
report.
No, but he's talking about scanner data.
I'm talking about scanner data. Yeah, across multiple retailers.
Then you can use the intensity of treatment, because they adopt this, like a greater share of their supply chain adopts this over time, and so
Yeah.
that should overall increase the cost over time, so that's the time eventually they use about that.
Nastya has a question online. Nastya, can you go ahead?
Yep, thank you. So one suggestion which goes around several questions asked in the audience about living standards, quality of life, and your outcome is often just log wages, log orders. I'm wondering if you could standardize your outcome as the gap to the poverty level, or somewhat like minimum living standards, because when you look at your figure 1, the largest increases are in Bangladesh, Cambodia, Vietnam, and India and Turkey. They're more or less flat. So I'm wondering if you could characterize your result, or at least provide a descriptive statistic with respect to how much gap to the poverty level or minimum living standards this wage increase closes. So essentially, if you take if the person was working full-time, how close he would be to the minimum poverty level in the country, because it seems to be a useful statistics given the fact that if you increase these wages by 5% and the person still cannot make it like 30% to the minimum poverty level in the country. Thank you.
Thank you. That's a very nice suggestion. Yes, thanks. Yeah, but currently the version of the paper that we have, the results that you can see here, we're estimating percentage point increases across the individual implementation of the program elements. We're seeing a 2 to 3% increase when we model everything in isolation. Modeling everything together, we see that the wage effect on the workplace dialogue program is insignificant. And the cumulative effect here 5% across all these interventions together. Here, the analysis on the any wage program indicator, and we also include lagged indicators to see the effect over time. We see it takes this effect becoming insignificant in the third year of the implementation, and again, a 5% point increase of wages over the 3 years. This is our event study where we see a lack of pretense here, and also for the third year, an effect size approximating 5%.
Yeah, I still, you remember, I still don't completely agree with the coding here. So I think that the figure out is nice because it seems like here you're just lagging.
Just a touch, please.
Excuse me.
Speak up just a little bit.
So I think what you're doing in the table before is you're having this indicator for the entire post period, and then you're including further lags in there.
Yeah.
But that's just saying that you're not adding to that effect anymore, and you're taking out, it's all incremental, and you're taking out power with that. You either want to do this as individual indicators for just 1 year, and then do the pre-post breaking out, then you would kind of resemble this graph, because here you're seeing the third one, if anything, is higher than the first year or second year. So this is misleading a bit with the type of coding that you're doing there, where you're not helping yourself, because I would just revise that code.
Okay. So yeah, reporting essentially the results for this. Yes. Yeah, this is our result for, this is this is in the appendix. And again, I think for me, this was a meaningful result here where we're seeing an effect size that's much larger for the intervention into the systems. So here, the simple thought experiment that we're doing using the estimates from the previous model is to estimate a counterfactual wage bill, total wage bill in the absence of these programs, and then subtract that from the actual wage bill and just simply divide that by the number of total workers affected. And this gives us a $44 increase annually for an average worker in our sample, comparing it with only $1.6. This is our subsample analysis for depending on the supplier rating data that we have. Again, I think we've talked about this before. The effect predominantly happening in the lower rated suppliers. And this is an analysis where we look at the effect of labor union presence in our settings. So here we look at, first of all, the union presence indicator, whether presence of unions is associated with higher, lower levels of wages. We do not find evidence for differences here. And also importantly, no moderating effect or any sort of evidence that could speak to the accelerated effects of these programs where unions were present. So there's no effect on the interaction here. And we also do tests where we try to look at the similar subsample tests where we see effects in both subsamples, regardless of union presence. But the difference again here is not statistically significant. And this is consistent actually with the bulk of research that talks about the limited role of labor unions in settings.
So I had a question about this in the context, because you talked earlier about these two programs, like the workplace dialogue program and then the wage management system. And my understanding is that you can't really separate them because it was this, like the workplace dialogue came first and then you had this other piece, where the latter piece seems to be the piece that's truly resulting in some change. And I guess that's what this result is saying. Like a little bit in the paper, you can't really separate these. It could be both of them together. But the very first program, the workplace dialogue program, I think was supposed to actually improve, say, union presence or workers' ability to advocate for wages. So does this result let you say it really is the second piece? You know, like the mechanism by which the increased wages happen truly is the second piece and lets you separate these two programs out?
So union presence is distinct from, right, the objectives of the workplace dialogue. Not the objectives. You're right. Maybe a right test would be to look at whether union presence has led to, whether the implementation of the workplace dialogue program has in fact resulted in greater union presence. And then we could subsequently sort of test whether this then has an effect on increasing wages. This is not something currently that we're doing, but yeah, splitting this, instead of just focusing on this any wage program indicator, doing the test that way would be potentially informative about that.
I think so if you ultimately want to say like what part of this was like the mechanism by which wages increased.
Yeah.
And the paper talks all about how you can't separate these two.
Yes.
It feels like you
Because-
ideally would like to be, I think you might want to be able to separate the two. I mean, you know more clearly, you know a ton about the study, but I think you might want to be able to say it's really X, not Y, if you're trying to make comments about generalizability or something else.
Yeah.
And so I don't know that it's this test that does it, but certainly this workplace dialogue program should have, if it accomplished what you described that it should accomplish, I would think it would have some effect on unions, but might be an indirect effect on wages.
Right, but even what we are showing here though is that even if it led to the establishment of unions, right, this still doesn't really seem to have an impact on the wages. It's really the wage management system that's driving the results.
And like the grid and the other things that get implemented. So I think this enables you to make some even stronger conclusions about which of these two.
Yes.
Given the fact that the timing is not great, it's hard to separate them otherwise.
And just building up on that, I think a big element for why this is complementary is because a lot of the communication set up the stones for what goes into the wage management system per se as well, right? So designing or setting the right wage levels, not necessarily the establishment of the unions, but the reason why I'm saying it's complementary is because a lot of the information that retail and also management is gathering from these communications is really going into the buildup of these systems per se.
I see. So you actually want to argue that it's both of them together.
Yes, I do want to argue actually it's both of these together. It's a critical element. Again, it's not a mandatory sort of adoption where we're uniformly applying exactly the same system, right, to factories. Inevitably, there is going to be some adjustment to the local conditions, right? And the workplace dialogue program is a big element in allowing the wage management system to cater to these local conditions to that extent as well. That's the reason why we are basing all of our inferences primarily to the any wage program indicator, which is in essence this big indicator for any interventions regarding awareness of these wages to happen at these factory floors.
But if it was both of them, if it was complementary, then wouldn't you expect to see something here? Because wouldn't the workplace dialogue program feed into some type of union power?
So the dependent variable here is not wages, right? Is wages, sorry. But here the union friends, I think this result actually speaks to the fact that unions, even though they're established, right, in these developing countries, have only a limited impact in really making an impact regarding the wages. And this is actually consistent with the weak institutions that we are operating here in.
We have one question online and then Atif, and then I think we're going to get close to like 4 more minutes.
Okay.
So Atif, quick question, and then Christine will go to you after Atif.
Actually, just a quick clarifying question. The constant dollars, I think, takes care of the inflation. But I'm just trying to think through the Turkey and India result being sort of different from others. If there's perhaps an effect of currency devaluation, the fact that you're measuring these in dollars, because maybe it has an effect on the magnitude of the effects if you were to measure them in local currencies and perhaps percentages rather than dollars. I don't know if there's a difference because of the devaluation effect.
So we also do the test with the raw local currencies. I mean, this is what we're doing, trying to adjust for it and also just leaving it raw and find similar effect sizes in both cases. The percentage point estimates are robust. Additional question?
Yeah, Christine, go ahead.
Okay, hi. I'm sorry to pull you back, but this question was from your main results slide. I wondered, to me, the interesting result is the magnitude, right? So similar to what Anna was saying, that, how do you define effectiveness? I wondered if there's some way to benchmark the 5%, like, are there other similar contracting studies that you can compare that magnitude to kind of give us a sense for, is that 5% effective?
Right, and I think for that reason, the earlier comment, I think is very helpful to put this a little bit into perspective with regards to the living wages. I do not know of any, again, this is an intervention that is sort of targeting the wages per se. I do not know of any like field-related studies that actually have these interventions for these. Also, I don't know yet on the top, they're a good benchmark to which to compare the effectiveness of these programs per se.
Okay, 2 more minutes.
Okay, I think I'm done with the main results gladly with wage effects. These additional results is effectively everything remains the same. We have only the orders on the left-hand side. This is a result actually that I wanted to show you, which is not currently included in the paper, but we have limited data from starting 2017 until the end of the period on the total workforce. And here, at least for the same estimation, the fixed effects model, we were not able to find a decrease in the number of workers. In fact, it has increased. So this is what we try to do with additional data as well to calibrate some of the effects. Discussion around potential other effects, I think we have talked about these as well. Couple of robustness tests because we are concerned about selection into treatment and the potential dynamic treatment effects inherent in the staggered diff and diff research design that we're employing here. Also do a couple of tests regarding the overlap of the nature of the programs and doing a little bit of trying to tease out from where the effect comes from. And it's primarily really in the wage management system that is consistent throughout, which seems to have this big impact. I think though, to wrap up this presentation, I would like to conclude it with a contribution slide. First, to the academic research, the literature, I think most directly we're speaking to the management accounting literature on the work on management control systems for CSR outcomes. But I think our findings also have relevance for issues around CSR reporting and the measures that we could think about when we were thinking about the right standards. So that is there. The strategy literature also, where I think a big still standing question is whether management controls practices can have can be diffused across different organizations. But I think for me, a big implication slide here for practice is I think that a big message, I think a lesson that corporations can have a big impact, not only by diffusing their developed practices, but I think for us accountants, actually thinking more about the measurements that are needed here in order to validate really what's happening on the field to speak to CSR outcomes. And I think I would just love to encourage, I think, if it's possible, to get more dialogue with corporations and potentially also with interesting data that could address this huge CSR effect from a multifaceted angle. So with this, I would like to thank you very much again for all your attention.
20-minute break and coming back at 45.
No, I was just
Everyone, so we're gonna try to get going on time for the last session, especially, some of you may have a tight time on when you're leaving, so thank you, welcome back. Getting back on time. So we're gonna have the last session, it's gonna be starting in a couple of seconds after I get a chance to list everything. So Daniela will be presenting co-authored work with Karthik, Raphael, and Ramesh on social unrest as an impetus for racial diversity. As with all the previous papers, we'd like to give Daniela up to a full 10 minutes uninterrupted to set things up. And then, as we've been doing a pretty good job of, if you could keep the questions fairly linear to the actual order and progression of the paper, that makes everyone's life a little bit easier. And with that, let me turn it over to Daniela.
Perfect. Thank you everyone for being here. I'm the last presenter, so I'm very excited to be here. My name is Daniela and I'm at UNC. I want to thank the organizers and the editors for accepting our paper into the conference. I'm very thrilled to be here and I will be happy to hear all your questions and comments. So this paper is co-authored with Karthik Balakrishnan and Ramesh from Rice University. And I should turn this on. And with Raphael Kopat from UT Dallas. So let me start by stating the research questions that we address in this study. Okay. So in this paper, we're interested in answering how does racial diversity impact stock market valuation? Do societal pressures for racial justice alter corporate behavior? And if so, what are the economic consequences of these actions? But first of all, there must be some sort of equilibrium where firms choose the level of racial diversity that benefits them. And in fact, if we believe that capital markets are efficient, they likely incentivize management to arrive at that optimal level of racial diversity that maximizes firm value. For instance, Bernie et al. Find that board diversity, broadly defined, contributes to firm performance. And there's also evidence that there are benefits of better matching talents with opportunities. At the same time, there are a lot of external pressures to promote racial diversity that could influence the equilibrium in one way or another. For instance, we observe proxy advisors starting to pay attention to racial diversity on boards. And we also saw regulators and stock exchanges starting to pass mandates to require more racial diversity. For instance, California required public firms to have at least 1, 2, or 3 members of underrepresented communities in the board, depending on the board size. And we also observed NASDAQ recently required most listed firms to have at least 1 woman and 1 member of an unrepresented community on the board, or to explain why they haven't complied with that. Companies also face pressure from various stakeholders to conduct something called civil rights audits or racial equity audits to precisely assess the level of discrimination and the racial diversity issues at the workplace and try to address them.
Yes, questions about this.
Can we hold off for 10 minutes?
Oh, sorry. No, it's okay. I'll come back to you first, promise.
You'll be first.
You'll be first, okay. So these external pressures, there's a lot of questions about the value of diversity. In particular, some scholars are skeptical about the benefits of regulation to promote racial diversity. And in general, there's very little research that provides causal evidence on the value of racial diversity. So here's where our paper comes into the picture. We're trying to shed some light onto these issues and to bring more conversations into this discussion. The way we do that is we have a shock to the equilibrium. We use the murder of George Floyd as a shock to the demand for racial diversity. George Floyd was an African-American civilian who was murdered by a member of the Minneapolis Police Department on May 25, 2020. But why is this event so special from a research design standpoint? Well, first of all, it was an exogenous event. We can see that from a graph here of Black Lives Matter protests, and we can see how this protest spiked right after the murder. This was a significant and material event. You can see again from the graph, about 700 different protests in the US happened, and the response was huge. But we're not really concerned about power issues as it typically happens for other diversity-related empirical analysis. This shock also predates any potential regulatory and legal actions in contrast to other settings where there may be some anticipatory effects and where expectations are continuously being updated. So overall, we see this as a cleaner setting to causally study how social unrest, unexpected social unrest that is focused on racial diversity, can influence firms and their shareholders. So the first thing that we do is to look at who is exposed to this shock. So our argument is that racial diversity becomes more relevant after the murder of George Floyd, but there must be some firms for which this happens even more so, right? Those that are exposed to diversity. Now, the problem is that diversity exposure is an unobserved variable. We do our best to try to capture it with different proxies. The first proxy that we use is lack of Black director participation in boards. The idea here is that a lack of Black directors is likely to reflect more serious diversity issues within the organization. We also use the discussion of diversity in conference calls. The idea with this proxy is that those firms that spend more time talking about diversity, that feel that need to discuss this topic, are more vulnerable to these issues and therefore more exposed to diversity. So in this graph, I'm showing you here the portion of firms without a Black director before the murder of George Floyd. This is our first proxy. And as you can see, it has mostly remained constant. About 3/4 of the firms do not have a Black director before George Floyd. So that's our first measure. We also look at the discussion of diversity in conference calls. And in this graph, I'm showing you the percentage of diversity sentences by calendar month. And again, we can see that right after the murder of George Floyd, there's a huge spike in the discussion of diversity. So with these two proxies, we now are going to look at valuation effects of racial diversity. The first question that we ask is, how does racial diversity impact stock market valuation? And to that, we find that firms that do not have Black directors experience a share price drop of about 1.5% around immediately right after the murder of George Floyd. We also find that those firms that talk more about diversity in conference calls also experience a share price drop of about 0.7% around the date of conference calls. We are aware that there may be some alternative explanations that may explain our results, but we try a series of empirical analysis to try to rule them out. We include a series of control variables, we bootstrap our standard errors, and we implement several classification tests. So we believe our results are quite robust because of this analysis. And to our second question, do societal pressures for racial justice alter corporate behavior? We find that indeed there is a sharp increase in the number of Black director appointments after the murder. We can see that in this graph where I'm showing you the composition of Black directors over time. And we can see that right after the murder of George Floyd, there's a huge spike in the percentage of Black directors on the board. Perhaps we can see this more clearly if we look directly at the appointments of Black directors. So as you can see, before the George Floyd murder, about 6% of all of the appointments were Black. But now after the shock, between 20 and 30% of all appointments are Black. So this is a huge increase in corporate behavior. Now, for our last question, what are the economic consequences of these actions? Well, we find that the market likes it. There's a positive reaction to Black director appointments after the murder, but if this additional diversity comes at the cost of enlarging the board, then that positive reaction is muted. Interestingly, we thought that perhaps the new directors that are coming in are bringing some skills that are new, and that's why the positive reaction is happening. Well, we find that there is no evidence in the change of skill set. We look at a series of skills, and we find that they mostly remain the same in the pre versus the post period. So that's not it. And that means that companies are simply not compromising on director qualifications. But we do find that Black directors are becoming busier after the murder of George. So this is going to be the agenda for the rest of the presentation. We'll talk about the social significance of George Floyd's murder, talk in more detail about the measurement of diversity exposure. Then we'll go into each of our analyses that we do to try to address each of our 3 research questions. So I still have 2 minutes and then I'll go into questions. But the first thing that we look at is how vigorous was the social response to George Floyd's murder. So here you can see a table of Google Trends of various events of violence against African Americans. And I want you to pay attention to the coefficient on George Floyd. Maybe you cannot see it, but it's 169. It's an order of magnitude larger than the other coefficients. That means that the response to this event was much higher than to other events. We can see that too if we compare the response to George Floyd, which is the red line, to other events now related to gender diversity. Here we are comparing it to the Harvey Weinstein, the Bill Cosby scandals, and the Me Too movement. And again, the response to George Floyd was an order of magnitude larger. So gender diversity is important because there are a few papers that are looking at the Me Too movement. For instance, Billings et al. And Leeds et al., they find that firms that generally embrace gender diversity have positive returns around the Me Too movement. But in this paper, we are arguing that gender and racial diversity are two separate issues, both important, but that both can have a different impact on the economy. In fact, we do find that the determinants for racial and gender diversity are different. For instance, institutional owners have a much larger impact on gender diversity than racial diversity. But I will be happy to take questions.
Abby, I think it's first.
Yes,
And
I
I
will
would
take-
want to mention as we get going that I am monitoring the Zoom. And so if those of you on Zoom would like to ask a question, please just use the hand raise feature and I will recognize you.
Okay, perfect.
So, sorry, I jumped the gun.
No, no problem.
So my question was really trying to understand the starting position that firms were optimizing before George Floyd due to capital markets. And I'm just trying to understand what you mean by they were optimizing. Because that seems to me against the grain of hidden bias and all kinds of things. So did you think it was optimal before and now it's moving to a different optimal just because everybody's aware of it? Or I'm trying to think through this optimality.
Right. So we believe that before George Floyd, there was some demand for diversity, right? Some different parties value diversity differently. But that demand is what was changed because of the shock. So we believe that the shock changed how various stakeholders view and have the perspective about diversity. And that might have changed either the cash flow part or maybe the risk, the discount rate. But in overall, it changes the present value of expected future cash flows. And that's what's really driving this change, right? These expectations are going to be funneled through investors, and that's what's really moving the optimal. So yes, before there was an optimal, but now it is changing because of this demand that has suddenly switched, and that is what is driving this new level of diversity that is now maximizing that profit.
So I totally follow you on how George Floyd could change the cash flow consequences of lack of diversity, because all these stakeholders are up in arms. I'm just not sure I'm totally convinced it was optimal before.
Okay.
You know, that the managers, because there may have been serious biases and they hire their friends.
Right.
You know, there's networks and things like that.
Yes.
So I guess the word optimal may be
Right.
what I'm trying to figure out.
No, and I think that's a fair point. We're not studying exactly what the optimal level was for George Floyd, and it's possible that maybe it wasn't optimal. But what does the shock does? Perhaps the shock is allowing people to understand these issues better and to realize, hey, this firm was not at an optimal level, and now this becomes important. And now, because of the demand, it's moving to an optimal level. So perhaps
Moving in a better direction.
moving in a better direction, right? So that could be a way. Yeah, no, thank you. Good point.
There's more follow-up, but whether you assume if it's opt or not, change the expectation of the market reaction, right? If you assume it was optimal, then you could explain the negative returns that you have. If you assume that there was a problem, then actually I would have expected a positive reaction. Doesn't that affect your prediction about whether you expect the market to react, depending on whether you assume optimality or not? Because I would say this shocks a problem that now there is an opportunity to fix. So now the market will actually react up, not down. For the firms that had low diversity, to the extent they were in suboptimal position.
Oh, I see. So if it wasn't optimal, now.
It's the opportunity to fix. So then investors will react positively because now finally there will be change. So I guess that the assumption of optimality is important on the prediction of the market reaction.
Let's see. But even if we believe that perhaps these firms could not have their diversity issues exposed before.
But now they can. So then there's an opportunity.
Right, but so the whole point that we're trying to do is that this is happening for firms that were exposed to diversity in one way or another, right? You can think of firms that perhaps are B2C and they're more likely to be affected by customer boycotts if this happens. So we're not really talking about the optimal level before, but we're saying that this shock changed the expectations of what is needed, and that affected on average firms, especially those that were exposed to diversity. But I see your point.
I would just to say, I think this is really important because it sort of suggests about whether, if all the firms are doing are responding to social pressures, that's not really telling us anything about the value of increasing diversity per se, right? They're just, it could be any, if there were any, crisis and they responded to that crisis, that could affect the firm's valuation, right? It's not telling us that there's something, incrementally valuable about racial diversity here in this context, right? It's saying there's something valuable to catering to what, the social environment is suggesting. What you would need is, right, because if they were optimal before, now they're optimal. And that just means the optimal response is to do what, cater to what the society wants you to do. You would need to compare this to, adding, having a more diverse board in the absence of this kind of shock to start to get a sense of learning about what racial diversity per se can add to.
Yes, and I guess we're not really taking a stand saying that this resulted in a better outcome and that this is the way things should go. We're just saying that it was important for investors and it was a change in expectations that ended up affecting the present value of expected future cash flows, and that matters to investors. And we see that through changes in stock returns and firm valuation. And also perhaps this is not a permanent thing. We're not saying that this is how the new equilibrium will always stay that way. But this is something that at least because of this shock, it happened and it was important for this.
I agree. All I'm just saying is that you can't say whether that's responding to a societal change in values or whether it's something about race per se.
Okay, yes, I think that's a fair point. Our current setting, what it's not really telling us how how the shock affected utility functions of different stakeholders. It could have been that people just value diversity to say more, or it could be the cash flow story or the risk story. We are at this point not disentangling these changes, but we're just saying that it has this impact on stock marketization, right? It is
I like your idea on open slides about the idea of inclusion and diversity and the idea that capital market pressure can help discipline actions. I like that. I just want to clarify a little bit on that, because as we learned from the real effect literature, whether the market is efficient in discipline actions really depends on informational frictions, right? For example, if you say we don't observe diversity, is unobservable, then you're going to get under investments in diversity. But suppose you have client information on the manager side, and then you could probably get over investments in diversity. Are you going to explore informational frictions around diversity to think about whether the capital market is really efficient in discipline action?
I guess that is going back to what was the optimal level before and what that happened, right? But we're more concerned about what happened after the shock. And again, I don't think this setting allows us to disentangle those effects. This is just a shock to the demand for diversity, and we can only see the consequences.
I'm more thinking about informational friction about diversity. I don't know, because you seem to suggest in one of your slides that diversity is unobservable.
Right.
I would expect you to get some sort of underinvestment in diversity compared to the optimal equilibrium level.
Well, diversity exposure is unobservable, right? I mean, but we can we can look
That's
at?
gonna hurt discipline by the capital market, right? If capital market does not observe diversity measure, then as we learned from those very next models, and then you're gonna get underinvestments in diversity. So in that sense, if you get anything to increase diversity, that's really beneficial for the society. So in that sense, reducing those informational frictions around diversity is also important if you want to achieve a optimal equivalent level of diversity.
Yes, yes. So I think we need to think more about that. Perhaps. It's an interesting. Ed?
Yeah, so I think this is an important study. I'm glad you're doing it. But this market reaction piece I found to be a bit muddled. I wasn't really quite clear what the role of it is. And it kind of gets back to a little bit about what Mark and others were talking about. I don't know how to interpret it. So if there's a negative stock price reaction, is the market anticipating that firms are going to be diversifying their boards and view that diversification as negative? Or is the shock itself changing the equilibrium within the firm? Like, I don't know how to interpret that
Right.
result.
So several ways. Firms that are the most exposed to diversity, these are the ones that are having this negative reaction, right? But what is the problem with having more exposure to diversity? So we think of several avenues, for instance, customers who boycott products of these firms, employees who sue the company and maybe leave the company and work for other places where they see a more inclusive environment. Regulators who pass mandates that would require additional costly diversity, even activism to disrupt operations in one way or another. So all of these activities, they perhaps have these effects that we're observing on the expectations. That's what's affecting these firms.
Well, I agree with you, but I think what I'm saying is maybe take it even a step further back.
Okay.
To me, it's felt like the returns test and then the board diversification are two kind of different things. And I didn't really know what to make of these ex ante, the stock price reaction in a 3-day window around Floyd. Because, well, firms are going to do a lot of things over the next month or so. It's not at all clear that that's even an efficient stock market reaction. The market hasn't had a lot of these things to learn from. And I'm not really sure how it actually answers your question, like your research question. So to me, it seemed like an important study about what motivates changes in a board and what are the stock price reactions to board diversification and things like that. I guess you can just take it as a comment. I didn't really know what to make of the stock price reaction tests. And
Yes, I mean, it's a fair point, but we do see it as bringing important evidence on the valuation implications of racial diversity, because clearly investors are reacting to it. So there must be something about being exposed to diversity that is damaging firms one way or another. But I see your point.
One thing that maybe would help Ed and link the two studies a little bit closer together is there's actually sort of a literature on catering. For example, dividend catering. That investors who want dividends, they value the firm with dividends and they get their dividends. I mean, I think kind of the same thing is going on here. At least under one interpretation, that investors preferences are shocked and they value diversity a bit more on shortly after George Floyd's murder and they get their diversity.
I would actually interpret Ed's comment differently in the sense that the market is reacting in part to the exposure, which is the story that you highlight.
Right.
The market also responds to the future actions, right? And so for instance, I think what really matters, like I think it goes back to Raju's point, if you think that they're gonna now have an opportunity to change something and before they just couldn't for whatever the friction is, then you should see a positive response. But if maybe the issue is there's a supply issue and we can't quickly increase the diversity of the board, maybe because the environment, the society has changed now, the firms that have these issues get a negative reaction. But you see that it's all contingent on what's that environment, what's the expectation for the future, whether you can sign that stock market reaction or not. And I think that's what Ed was saying.
Right, and we do have evidence that it is costly to hire other Black directors. There are some supply and demand factors that affect hiring Black directors. So if it was cheap, if it was not costly, if it was costless, then we wouldn't observe that negative reaction, right? So I think it is part of that.
It's a market reaction may not have anything to do with the board of directors. I mean, you're using diversity on the board as a proxy for
Right.
diversity issues at the company. How much do they talk about it in conference calls, earnings calls?
Yes.
But the market could be reacting to something way broader than just, are you gonna add a director? or not?
Yes, that's happening.
I bet, but along these same lines, I think we're talking about diversity exposure to diversity, and really it's two components. It's this lack of effort versus having an effort, right? So are you exposed to some general risk? And what are you doing about it? And I think some of your measures are encompassing both, especially the textual. You can separate them. I think a lot of these predictions will get easier. I don't know if it's a matter of acknowledging that not having Black directors is a proxy for potential exposure to risk, and or maybe how many questions they get on the calls about it is a lack of effort, whereas having more specific phrases that are related to diversity efforts that they're engaging in, that's not about risk, that's about their efforts, and separating them might
Yes,
help with the
yes, I think
predictions.
that's a good point, and maybe I can show you some of that. So this is talking about the conference calls. So there is actually a literature talking about using measures based on conference calls. For instance, people use political uncertainty, Brexit, climate risks, cyber attacks as topics that if companies spend time talking about these topics, then they're more exposed and vulnerable to those. And I'm glad that you mentioned the textual question, because we do try to get at that with looking at passive versus active words. And we try to see how firms are talking about diversity. And for instance, firms that are more passively talking about diversity, they are even more exposed to it, and we find a more negative reaction to those firms, right? Is that sort of what you
I mean, yeah, I think you can go even farther in terms of first just seeing, is there any kind of an effort? Are people asking for more from them? And then looking in here, I mean, I guess I like on this passive active, I was excited to see it, but I think you would benefit from having some validation or examples or something. This was hard to get my arms around. I wanted more like, how many initiatives did they say that they're going to undertake? What are concrete actions that they said they were going to do?
Yeah.
Something so that the people listening feel like they're actually taking it seriously versus just being like, oh yes, we want diversity, moving on.
Yes, yes. No, that's interesting. And I think we can get that probably. I mean, we'll think about it, but and right now we're looking at board composition as one way of doing some sort of action. But that's one thing that we have, and we're thinking of other outcomes, perhaps donations to companies actually take some other avenues to implement the diversity more. But perhaps we can explore conference calls a little bit more. That's a fair point. Thank you. Okay, sorry.
Thanks, Suresh. Just maybe taking a step back and on the conceptual level related to ads and Abby's point before. So racial discrimination obviously is a big issue, but then I think it's more a societal issue or ethical issue, but you're looking at it just from the investor's perspective. And I think we know, well, for the investors, if we can have forced labor and zero wages as we had back a couple of centuries ago, that's great for the investors, but that really is nothing good for us to look at the stock price there or the market price. So I really am struggling a bit whether, given this importance of this topic and this giant unrest, that we're just defaulting to going back to the lamppost where we as accountants always look at public equity markets, market reactions, and board composition because we have the data, but not necessarily because this is really helping us to address that issue. So how are you thinking about that? I understand there's just one study can't solve everything, so we need to make some progress, and maybe that's the best we can do. But how do you think about this broader notion that this just, I don't see how it really affects this big motivating part about racial diversity because or discrimination, because you then immediately took it as, oh, this is an exogenous shock. And I know we like to go for these things, but do we do justice to the issue here? How do you think about that?
Oh, that's a tough question because you're asking me to solve the problems of the world. Yes. But that's a good point. And I guess we're not taking that normative stance on what should be done. And in fact, in one of our analyses, it's very interesting that we find that the skills that the newly appointed directors are bringing are not different, and that's surprising to us because we thought that, hey, maybe they're actually working on some different stuff. And no, apparently it's just the market values having a Black director. But we're not really taking a stance. I think it would be a super interesting avenue. If you have any suggestions on how to get there, but I think it would take more than one paper to accomplish.
Can I just comment on the skills?
Yes.
So skills as you measure that, but they clearly have it can add a lot of value to the work. That's sort of the point, right? That they think differently, they world differently. So it may not be their CPA club skills or whatever, but I think your life experiences can be really valuable.
Yeah,
Discussion.
and we can, exactly, that can be part of the positive reaction as well, right? We just try to look at the skill set to see if they're being hired for a specific purpose or not, and that doesn't change because of the shock, right? But of course, there must be some other benefits, and that's perhaps the reason why that's it. Job returns. On this side, yes?
No worries.
Okay. Henry?
Go ahead. Sure, thank you. So building on Mark's point from a while ago, a little bit earlier, there is a somewhat recent but quickly growing theoretical literature, and this is somewhat self-serving because some of the papers are by Mirko and me and other co-authors. But a lot of the modeling techniques have been to incorporate explicitly investors who care intrinsically about something other than cash flow. So they do care about child labor. And I think it might be useful to look to some of those papers in accounting and finance to get a sense for what happens if you have a shock to the preferences of investors. And it could flow through cash flows, but it seems like you also have this potentially direct effect of this becomes more salient to investors. It was a heinous murder. This dimension of firm characteristics becomes more salient. What effect does that have on prices, what firms might do, and then the reactions to information? And I think a lot of those are actually in the theoretical. But it could help with maybe disentangling some of these issues, not from a measurement perspective, but from like, what might we expect to be seeing? And maybe are there patterns that help us discriminate across different potential alternative hypotheses?
Thank you. That's interesting. We'll take a look at it.
I mean, sort of just building on that, there's an empirical paper, Hong and Kaprachek that talks about sin stocks, that sort of tobacco stocks outperform and they have a higher discount rate. I think, through that vantage point, I think one of the things that you're sort of maybe looking at is that, this is the opposite of a sin stock. During 2020, people started valuing things other than cash flows. And, the George Floyd murder was heinous. I mean, one of the things that we haven't talked about is that, through the pandemic, that was, just such a, visual event because of the context. And it was Memorial Day weekend, and it was just very depressing. And, I think in some ways you're sort of maybe documenting.
Were you on your in-laws' couch?
I was sitting in a kiddie pool, drinking Trulies. Related to the sin stock idea and sort of being the opposite of the sin stock idea, 2020 was actually the best year for cigarette smoking in the past 2 decades. The only year cigarette sales didn't go down, and there was a lot of shifting into premium brands. It's a terrible year for cigarette stocks.
I love how you keep track of that.
I'm glad I let Henry speak first because what he's talking is kind of related to what I'm talking about. It's related to Rodrigo's point about how would you explain this market reaction in terms of what happened before and after the George Floyd incident? Because if Rodrigo is saying if this is a problem, then when you're trying to fix the problem, then the stock market return should be positive instead of negative. But instead of, as what Christian is saying, suppose people are observing that you're trying to solve the problem, but you cannot solve the problem because of supply issues, then of course market return is going down. But that could be alternative explanations. The one thing is maybe what we were having before is a good equilibrium. And now, you're trying to disrupt the good equilibrium, or firms are just going to do some social washing. They're just going to, try to install some Black directors on the board, without really improving the firm performance. In that case, then the return could also be negative. Another thing is kind of related to what Henry is talking about. Would this George Floyd incident be a preference shock in the sense that more investors may be aware of this kind of, social preferences? In that case, then, Henry already mentioned his papers. His paper's prediction would be your cost of capital would increase, in particular firms with less diversity. And as a result, your stock return is going to drop. So, there are all these, sorts of different explanations, which is kind of hard to determine, just using the market return. So maybe, one possible issue to look at is you have this negative return for firms with 0 Black directors. Maybe you can see whether or not that return difference actually reverts, over a very short period of time. Because if that's the case, then all of these explanations are just not valid. We're just saying that, market is just kind of responding in a very emotional way. And, there isn't really nothing changing.
Right. Yeah, again, we're not saying that this is a permanent effect. Maybe it is story, but the fact that it happened, shedding light on how investors are reacting to it. But I agree with you that we cannot say, exactly what went to the facility function, and perhaps not in this setting, but if you have other ideas of how to identify this type of this, we can.
And Danielle, may I suggest you move forward a bit before you take more questions?
Yes.
Move forward.
Okay, yes.
Thank you.
So just to motivate a little bit more about conference calls, this other measure. So before George Floyd, about 2.2% of the conference calls talk about diversity, but after the murder, that actually changes a lot, about 17.5 to 20.2, and it's now stayed at 10% of the conference calls. So this is just to show that the relevance of the event was high, and it's not because conference calls became longer. We looked at the number of sentences and they stayed mostly the same. So the response to George Floyd murders discussed more about diversity issues. So for our first research question, how does racial diversity impact stock market valuation? Again, we talked about these firms that are more exposed to diversity and different ways in which they could be damaged. And this is one example of one of those. For instance, recently Tesla was hit with a $137 million judgment in a racism case. So this is an example of how firms could be damaged by employees suing the firm. And just to have a talk about the research design that we use in the market reaction, again, our identifying assumption was that if diversity exposure matters, then those firms without a Black director are going to face a stronger negative market reaction. We use abnormal returns, starting with the trading date after the murder, and we run a regression on our indicator variable, no Black. So these are the results of that analysis. As you can see here, firms that do not have a Black director tend to have a more negative reaction. And we thought about an alternative explanation that perhaps it is because of all these protests that were happening. Maybe firms were simply damaged because of all of these protests were creating a lot of violence. And we have a subsample of firms that are not located near protests. And that's the second column. And we find that they still have a negative reaction. And very interestingly, we thought about other ways in which firms could be exposed to diversity. For instance, those firms that have a higher proportion of non-Black employees, they tend to have an even more negative reaction because perhaps employees do not feel that they're working at an inclusive place. And again, as I was mentioning, B2C companies may be more vulnerable to customer boycotts, and thus they tend to have a more negative reaction. Just to talk about this slide, we ran a quantification test. This is an example of one of them. We looked at other events of violence against African Americans, and we do not see that negative reaction for other events. I'll take some questions. I think Anya, you were
very interesting paper. I was excited to read it. One thing that kind of sparkled in my mind when showing the slide about Tesla news is essentially what you're doing in the paper is you're making this implicit assumption, maybe the investors are making it, that the existence of Black directors on the board is going to necessarily mean that the company is more inclusive, treats their employees fairly, etc. Right? So in essence, it assumes that once the Black director comes on the board, then they become somehow responsible for the policies of the group, right? And ideally, I mean, I'm not sure that I would agree with this assumption, right? We need a set of, like, ideally, the company would need a set of internal controls and procedures, HR procedures to kind of work through those issues. One proxy, you know, if they're doing well, then sure, they will have Black directors, but having Black directors doesn't necessarily mean that they would do well and treat their employees fairly. So wondering if there's another way to like look at conference calls, data that you have to kind of extract information about something exact. That's just coming back to that.
Yeah. So we started looking at the boards because we believe the board sets the tone, and it's a first step towards addressing the issues. As BlackRock says, diversity at the board serves as a catalyst for making the necessary changes in business practice. So we believe that, yes, maybe it doesn't reflect everything that the firm is going to do. It's just a first step, and maybe that's what the market is understanding. So this variable is just a proxy for broader diversity issues, but we do want to observe more outcome variables. As I mentioned previously, perhaps donations that companies are making, or some more initiatives that they're taking. And perhaps the conference call is a way to.
Yeah, but I don't think donations got that, right? Like you can make a donation and still like have the internal controls.
That could be one. What do you think would be some other actions that we could?
No, I don't know.
I don't know either. That's why I'm asking. Any suggestions? I'm happy, but yeah, we can think more about that, and that's a fair point. Perhaps we could observe more initiatives. Thank you. That's a good point. John?
Just to follow up on that, because I think there's literature on that, right? So like using at the gender angle, there was a Norway experiment, and Bertrand had a follow-on looking at are having these women on the board, does that trickle down? And she finds limited evidence that actually having more women on the board meant that salary gaps between women and men changed in these firms. So they're like, her point is very salient, especially if like a lot of this could be just window dressing, which might explain negative reactions in terms of the expectations. And then the second thing is like, could you do more stuff with like Glassdoor data on employees and talking about, like you can match it up to the companies, and I think you can.
I think that would be one way, right? If employee levels, if it's making a change at that level of the hierarchy, that could be another way of. That's a good point. Maybe on this side, Eric.
Thank you, Daniela. I had a similar reaction to one of Ed's earlier comments, thinking about like this event study portion, in that I think the protests that emerged were sort of like part of a movement rather than sort of like an event. In the sense that it wasn't immediately clear afterwards if it was going to sort of lead to this major change. And I think it sort of is complicated by like some of the stuff you have here, where like you call these falsification tests. It's a bit odd if people are updating their priors about the severity of the problem, but like you don't see them in other contexts. Like I would have hoped that you would actually find sort of similar effects from other cases where people are updating their priors about the severity of the problem. So I'm not exactly sure how you think about these, but I would just say like more generally, when you layer in like the issues surrounding a short-term event study, it might be useful for you to be thinking a bit in a longer-term sense. Like you guys do a nice job acknowledging that like insofar as there is this valuation effect, it can come through either reduction in cash flows or a change in the discount rates. It seems like you can actually look at those things as opposed to just saying like both of them could be happening, or we're sort of agnostic as to which one. If you look a little bit longer term, it kind of gets you around many of these issues we've been talking about, like people knowing the extent of diversity, whether like people are actually changes, and the fact that you only see it in this one particular event.
Right, that's, I think, a fair point, and we're not really sure why this happened at this moment. I mean, perhaps murder was the straw that broke the camel's back, since that it was some build-up, but at this point, this is when the movement really happened. And, that's a fair point. We're only looking at it in immediately what happened after the murder, if it triggers some behavior change.
Yeah, and I think just more broadly, the distinction between like whether this comes through reduction in cash flows through protests versus valuation, I think has very different implications. And so
Yes.
rather than just saying like it could be either of these, I think it would be very useful to do that, but it would also move you away from this event study, which I think embeds some issues.
Yes, that's, okay, thank you, we'll consider that. I'm trying to maybe here.
So I think the results in that table are interesting, but I don't think they speak to your stated research question at all.
Wow, I see.
When you talk about exposure, you wouldn't say like, what is the value of being exposed to variable rate debt? And then look at an exogenous increase in interest rates and conclude that taking on variable rate debt is unconditionally a bad thing. And that seems kind of like what you've done here. You've said we're going to look at firms that have a particular exposure. And what we're interested in knowing about is the unconditional value or cost of that exposure. And the way that we're going to look at that or answer that is by looking at an obviously negative realization. And in kind of any other risk factor setting, I would think that would be a really inappropriate way to answer the question of whether a particular exposure was good or bad. And so I'm not saying that your analysis is uninteresting. I just think that framing that particular research question and attaching it to that analysis doesn't seem to fit well at all.
I see. Yeah, perhaps we need to work more on writing, but I do see it as a way of people reacting to this particular shock, to this change in demand. And perhaps as I was saying earlier, maybe that's when stakeholders realized that this firm had some diversity issues, and that's where it became more prominent. But are we talking about the valuation effects of racial diversity? I mean, it tends to have an impact because firms that don't have enough of that end up being affected when shocks like this happen, right? So, but perhaps we need to think more about how to set it up. Thank you. Okay, just move on a little bit and then I'll come back to.
Is it okay to just make a really quick comment about the falsification test? I think a usual falsification test would be one where if the underlying effect were true, you would not expect a significant coefficient. And I think that there's an issue with calling these falsification tests because in some sense they seem like lower powered versions of the same thing that you use in your main tests. So like if these came up as significant, then you would conclude that like race matters in these events also. So that like if they came up as significant, that wouldn't falsify your, like it's just hard to view these as a falsification test.
Okay.
Because they seem like just lower powered tests of the same underlying phenomenon. So like not finding these.
And lower power, you mean because the response
Because they
was
got
not
less
as
attention.
high?
It seems like these are kind of saying like your mechanism is saliency. And these are just less salient so that we wouldn't expect to find a result. And the George Floyd is like the most salient. And that's, is that kind of
like the Hispanic director falsification test makes more sense because, you know, if the dimension is African American Black race, and we're not seeing that for other
I
racial
see, I
dimensions.
see.
But this is the same treatment, it seems, just with less salience.
It's like you're saying the treatment is actually just coverage. And like if it's like national news, then things change. If it's local or less salient, things don't change.
Oh, okay.
But is that your mechanism?
Yeah, I mean, we are looking.
Awareness.
We're looking at the 3 days surrounding each of those other events, but.
But is it like awareness? That kind of like the saliency of that's where I was getting caught up
I see.
in some of the tests. Is it simply like the saliency? So like you could have replaced this with some other event.
Even the 2% Asian results have to be already also suggest it's not just diversity, because there's a diversity where Hispanic, Asian equally should get a response.
Right.
The fact that you don't find one has the same flavor of what Henry was just saying, either it's because it's low power, or it's telling you that George Floyd is fighting something else other than just diversity, because obviously those other minority groups we would also want to see the same sort of reaction. So from a conceptual point of view, it's again the same things.
Okay. Let's move on quickly to the other results. Again, I was talking about whether there is a supply constraint of black directors. Here, we're gonna talking about the determinants analysis that is a critical assumption for market reaction analysis, because as I mentioned, if it was costless to hire another black director, then we wouldn't observe that negative reaction. So just very quickly, we look at a series of demand and supply factors, and we find that they are indeed important determinants. For instance, we look at whether the pool of black directors has an influence on hiring a black director. It does. We look at how connected the directors are in the local black population of the state where the firm is headquartered. And yes, both of them have an impact as well. This is just to say that it's not costless. But then, do we observe? Can we find a way to more clearly identify these valuation effects? This is where we look at the conference calls reaction, the market reaction around the date of the conference calls. And here we have our two diversity exposure measures. One is just the indicator variable of whether there's a diversity discussion in the conference call, and the other is the number of diversity sentences in the call. And we do find that firms that talk more about diversity are also exhibiting a negative reaction. We find this with a continuous variable as well. And we find that the results are stronger when we look at firms that talk more passively about diversity. So in general, for a first result.
Just keep that up. I have one question.
Okay.
Finish your sentence.
Actually, and before, I'm going to jump in with a student question.
Okay, sorry.
Go ahead, Mr. Sands. Go ahead.
Oh, that's okay. To finish my sentence, and actually, what is the overall finding for the first research question is that there is an adverse market reaction to this heightened diversity exposure for those firms that couldn't costlessly increase diversity. But then I will go back to.
That's right. And this may be from a while ago. So Nastya has a question. Nastya, please go ahead.
Thank you. So the question is follows, and it also builds on what was asked in the audience earlier, which is the encouragement to exploit the conference call setting more. In the conference call, you currently using the whole text, but you could also focus on what the company is portraying in the presentation section, prepared remarks, and also how much demand about these issues is coming from the analyst questions. And then also your list of words, like if you look at your table, one is quite generous on this dimension. You have a lot of D, E, and I terms. I wonder what would happen if you narrow it down to very specific terms, which is mentioning people of color, Black, African American, and just to see how much companies started to cater. So in the presentation section, and how much analysts really care about it. These measures would also be helpful before you go to before the George Floyd event, because it would essentially provide a baseline how much these issues mattered in the first place. Like some companies would really have to take it seriously if a lot of their customers coming from African American communities. So just maybe you could exploit the conference call setting more. Thank you.
Yes, thank you. That's a good point. And we did try looking at analysts versus, the Q&A session versus the prepared remarks, and even looking at the specific questions that analysts ask. But we find that the discussion is mostly centered on the prepared remarks session. And we see it as companies exposing this topic and feeling that need to discuss these issues. And about the actual phrases that we search for, this is just a picture of all the regular expressions that we search for. We try to look at several ways of searching for different phrases. And I mean, we try to include a set of different phrases related to diversity. But I think it's a fair point. We can perhaps exploit more that setting and that data outcome. That's yes. Another question.
But Danielle, I just wanted to come back to Andy Van Berk's point with a different example.
Yeah.
I mean, suppose the hypothesis was having an oligarch on your board was a bad thing. And then you went and looked at an event study around the Ukraine invasion. You definitely find it was a bad thing, but you haven't really learned anything. It's the same thing that Andy was saying, is that if you have variable rate debt and look for a time when there's a big interest rate increase, that's going to be a bad thing, but that doesn't mean the variable rate debt is bad. It's a conditional versus an unconditional.
Okay, so you're saying because we're looking at it in this specific setting at this time, that's when we are observing this negative reaction.
Yeah, the fact that you picked out an extreme event is actually a problem rather than not going to benefit.
But isn't that when we can observe how these changes in demand are affecting how everyone thought about diversity and all the perspectives and expectations changed? And that is what's really driving the realization that perhaps there are some implications of diversity that we were not aware of before. Because of this shock, now we are aware of them and we can see them as important. So, but it's because of this shock that now firms are becoming more aware of how these issues can have implications for firm value. It's not.
I guess, putting
Yeah,
Andy's
I guess.
words in my head, but it's just, if lack of diversity is a good thing in certain circumstances and a bad thing in other circumstances, you've selected on an extreme bad thing, and you can't conclude anything about it unconditionally.
I see.
It seems like in part what John's saying is it's an issue of whether this is a permanent or transitory effect. So having a Russian oligarch on your board might be fine in 3 years, but it's not fine now. And the question is this a transitory shock or is it a permanent? Like now you're saying firms are now aware of it. And the question will be, are they still equally aware of it? Are customers and other people, the social pressure still going to be as severe 5 years from now for firms that haven't responded to this shock? And if the answer is yes to all of those things, that's different than if the answer is no. Maybe 3 years from now, things will move in a different direction and people won't be quite so hopeful about it.
No, I'd love to know the answer to that.
I don't either, but I think what John's pointing out is that if you focus on a shock, that with hindsight, it's kind of like the paper yesterday, we knew that a pandemic in hindsight was a really bad one, but ex ante, it may not have been bad. Here we know with hindsight, this was a very severe shock. But, the question is whether does it lead to a permanent or a transitory?
Yes,
effect?
yes.
That seems important.
That seems.
I think you wanted, I'm sorry, Christian always wanted to say something.
Thank you. It's actually a small point. Just back to earlier discussions about can you actually sign the stock market convention, what you see. Here, what I really like is if you compare the passive words to the active words, it's a little bit unfortunate that you don't seem to get much action out of the active. But that would be more about like what they're going to do about it versus the passive is sort of like we have this exposure, we can't do anything about it. And there you're getting the negative reaction. You could sort of perhaps more granularly pull out stuff where they're saying, here's what we're going to address this. And then you get then you can, I think, more closely interpret this in the way you were saying earlier as sort of there's valuation of the diversity in the market. And you can unpack it. Just want to point that out.
Yes, thank you. That's a great point. And maybe we can look at the specific initiatives that companies are taking. Great point. Okay, Ed?
I'll say this again, but I think I see you've got two completely different questions. You've got the valuation effects of having a diverse board of directors. And if that's your research question, I think you got to do a lot to really dig into why is the stock market reacting the way it's doing? What is the benefit or the cost of having these diversity exposure? And then, but your title is like firms' responses to. I really see these as completely different questions, and they're kind of doing too much. I might just you speak to your co-authors, your editor, about how I just ditch this whole returns part and just focus on how do firms change their board composition.
But we need to say that diversity is important and have some valuation implications. That's
I think if you see that companies are changing their boards substantially following something, that's
That's
important
saying
unto
something.
itself, but that's an opinion, right? That's
yeah, no, right. Think about it. Thank you. Is there someone who has been waiting for like
Eddie
30
Ross has
minutes?
had his hand up for like 30
Okay,
minutes.
sorry.
Rachel has as well.
It's okay, I'm not important.
Oh, you're gonna say it anyway, right?
Yeah. Related to this, and it's somewhat the framing of the paper, but kind of the fact that you don't find any changes at all for kind of these other underrepresented groups, like during this period of time. Do you find that, like, and I guess your interpretation of all of this seems to be like diversity matters from a valuation perspective, but one could look at your results and it seems like largely related to saliency for one particular group, because it seems like, if people really cared about board valuation and board diversity in general, because they thought it actually made a huge difference, it's not like Hispanics are not underrepresented or even Asians are underrepresented. So it's like kind of like, and I'm interested to hear your thoughts on kind of whether you think that maybe some of your results almost suggest like social washing, where it's kind of like, all right, this one particular group was underrepresented. There's this salient event that everybody sort of focused on, but sort of, and so firms kind of respond, but they're kind of don't do anything else to like all these other underrepresented groups. I wonder if you have any thoughts related to that.
And I guess
And this is all just framing, so it's.
Yeah. I guess this comes back again to the question of what is expected of firms to do, right? Is it because currently this shock is talking about Black diversity, right? It was a social response to Black issues, and that is what the shock is conveying, and the changes in expectations are related to Black representation. That's where we observe it. But again, I don't think that means that companies are, now that they hired a Black director, are not going to be interested in other issues. As we saw, the gender, for instance, the gender literature finds that they also try to hire some women and perhaps the Hispanics and Asians or other settings are important and understand those, but this should change perspectives on Black.
But that's effectively just what you show, that kind of for Hispanics, the
Yeah.
needle doesn't move that much. And I know there were a lot of groups during this period of time that were sort of kind of representing these other communities that really felt that they were kind of the limelight was being taken away from them. And they were also kind of largely underrepresented, maybe more so. So it's just something to think about, whether it's saliency versus valuation.
Okay, perfect. Thank you. I'll just move on a little bit more to our analysis. For the second research question, do societal pressures alter corporate behavior? We're gonna be looking at a shift in board diversity in response to the murder. But the first thing that we do look is at that determinants analysis. We do this regression year by year to try to see if the supply and demand factors change. And in general, if we don't find much, perhaps other than the proportion of Black employees changing in the last 2 years. But in general, we don't find strong evidence that the supply and demand factors are changing. So mostly they stay the same. Then the question is, what is changing, right? What changes do we observe here? And this is the predicted probabilities of the two states of firms having a Black director and having no Black directors. And if we look at the first one, this is the likelihood of retaining at least one director. Again, we don't see much changes in here, but when we look at the likelihood of appointing a new Black director, these numbers substantially change from 2019 to 2020 to 2021. That means that those firms that didn't have a Black director are now more likely to hire one after the murder of George. And again, we see that also for firms that were exposed to diversity in the conference calls. Their likelihood of appointing director is increasing more for those that were more exposed to diversity by talking about diversity. Okay, so that was the finding for our second research question, but I'll take a question from Rachel.
Okay. So in that you can look at the effects that like the big three institutions had, and it was in general fairly weak results. Is that why you didn't look at whether ownership in like big three is related to any of your abnormal stuff? Or try to do a breakout of, is it retail or the kind of like green mutual funds that are driving your abnormal returns?
Yeah, we didn't find much evidence that they are strong determinant. For instance, when we compared it to gender diversity, we saw that they do have a big say on gender issues. But for racial diversity, we didn't find there was a key demand supply factor in our setting.
And that affected your decision with the other tests or just unrelated?
I mean, it's all related. We try to look at the key demand and supply factors that we thought would change over time or that would be, important in hiring Black directors. But yeah, when we looked at that, institutional owners were not a key factor.
Maybe move both these questions up and take them maybe before you.
Okay.
Joel, right there. Go ahead, Joel.
So I guess for me, like the really important thing, the important effects of the whole George Floyd death was that a lot of companies, it's not that they started to focus more on diversity, they started to focus more on racial diversity. And I think it's an important distinction, but I feel like we keep going back and forth between diversity and racial diversity. And I think this is only about the increase in racial diversity. So even in your like definition of diversity and your textual analysis, it feels like it's a lot of stuff that's not related to race, but that's really the effects that we saw from this event. So I feel like it's an important distinction that we keep kind of getting away from that, but we just need to focus, I think, more like on your textual analysis. I'd be super curious to see like in the conference calls.
Yeah.
Okay, so yeah, they talk more about diversity, but what about like specifically racial diversity? Are they talking more about Black and like saying the word race and all these things that are encompassed by specifically racial diversity?
I fully agree with you, and you are completely right. This is racial diversity, and we try to be careful even in the regular expressions. We actually did a separate regular expressions for gender diversity and with specific words in there. But for racial diversity, we do have words like African Americans, Black, and even all of these events, George Floyd, we have that word. So we try to set the paper as focusing on racial diversity. I agree with you that distinction is important.
I try to push forward and then we'll see if we have time.
Okay. Okay. So this is again just a graph that I showed you at the beginning, and just to show you that the Black director appointments is the one that increased the most. We don't have that on the other races. But let me move on to the last research question. What are the economic consequences of these actions? For here, we're going to look at how the market responds to the higher appointment of Black directors. And we are going to look at the abnormal returns around announcements of Black director appointments. And we can see it from this table that after the murder of George Floyd, if the appointment is Black, there's a positive reaction to these events. And we try to rule out whether the announcement was talking about other material effects. We only do a sample where the announcement does not have other types of information, and we still find the results in there. And very interestingly, we find that the results hold not only for the first 3 months, but for the rest of the sample, because there could be some directors that were being appointed before George Floyd. And even if we take away the first 3 months, we still observe those results. And we also look at the reaction when there's an enlargement of the board. And we find that if it is a Black director post George Floyd and the board is becoming larger, then the positive reaction is muted. But interestingly, I'm not highlighting this, but we find that there is a positive reaction to not having a Black director and hiring one but also to already having a Black director and hiring an additional Black director. Both of them, there is a positive reaction. And then we move on to do firms bring directors with different skills. And for here, we look at a set of different skills that directors may have. We do a tetrachoric factor analysis to put them in buckets. And we're going to do a multinomial logic analysis to compare the skills using white directors as the base. And here you can see that the null, under the null, the coefficient should be 1. But for Black directors, for instance, they tend to have more stakeholder skills. Asians tend to have more technology and academic skills. But if we look at what happens in the post-George Floyd period, we don't find that these skills are changing much. Again, companies are not compromising on the quality of the skills. I'll take one question, and then I'll.
We go back to your market reactions to the appointment of the directors. How would you interpret, you go back to the first event, the fact that the main effect is not significant, that there's no positive market reaction to appointing Black director in the period, like kind of to bring it full circle to our discussion here, the value of diversity, right? And if diversity increases value, wouldn't you expect appointing a diverse director to always increase value?
Wait, you mean in this table that you mean, or?
Sure, the fact that like it's only significant in the post period, right? Wouldn't you expect that if you just interpret Black appoint there in say column 4, to see most clearly, would you expect that to be significant if diversity?
Well, again,
matters?
we don't know because we don't know what the optimal level of diversity was in the pre-period. So we're not saying that every time you appoint a Black director, you always.
You should just suggest that the optimal level of diversity changed.
Yeah, I mean, I think he's trying to, say, I think he's trying to help you that basically, sort of the cash flow story, maybe you can use this test to kind of rule it out. Because you wouldn't expect sort of the marginal product, Black directors to improve dramatically around George Floyd, but you all of a sudden see these large market reactions. I mean, one thing that, is striking to me across these tests is you're seeing 1.8% market reactions to having a Black director, both in the shock and then, in the post period when you appoint a Black director. Those are very large valuation tests. It's difficult to imagine from sort of the cash flow perspective, any director adding that much, sort of value. So it sort of becomes sort of the optimal appointment. I do think that, your results and your story, I think line up quite a bit better with the discount rate portion than the cash flow portion. In addition, I will note one thing that we haven't talked about. The riots predominantly occurred the weekend following the George Floyd massacre, and they are not in your returns window.
Right.
So, I mean, I think, bringing that again would try and, get at some of these issues around the cash flow story and focus a little bit more.
Yeah, no, thank you. That's a great suggestion. I will.
Another suggestion about marrying up some of your tests, about like the market reaction when it happened, there were some negative reactions. What happens to those firms when they are they the ones that are more likely to appoint the Black director? And what happens to the returns when they announce that? And likewise on your conference calls, those that are talking about it, are they the ones that are more likely than to subsequently appoint?
We haven't linked those two analyses.
It feels very silent, and I think it would help if you bring these research questions together instead of viewing them so distinctly, because I think there's a time series of events here that would be nicely linked together to see those conditional results.
Yeah, we've thought about it, and I think that. Sorry, I have to conclude now, but I'll just talk about key takeaway. Directors become busier, and that's what we find in this last analysis. But to conclude, there is a growing focus on racial diversity that has engendered several actions from regulators, quasi-regulators, firms. Our study exploits social unrest to provide causal evidence on the consequences of diversity exposure. Some key takeaways is that we find that supply constraints are an important determinant of Black participation awards. Firms with greater diversity exposure tend to have that negative reaction to the shock. Firms respond by increasing Black participation on boards, and there is a positive reaction to those appointments. And their study leads to further questions. For instance, how should firms address the supply constraints that we document? And in general, is diversifying the corporate board an effective first step towards addressing racial issues in corporate America? Thank you very much for
Very much, Daniela. Thanks very much, Evan. It was great to see people in person. Also, thanks to those who joined on Zoom who couldn't come in person. Next year, we're excited. We'll be down in Hyde Park in a nice new building called the Rubenstein Forum. I hope a lot of you will be able to join us in person then. Safe travels to all of you leaving. We do have box lunches immediately outside here if you want to pick them up, and you're free to eat them in this room if that works well for you. So again, thanks so much, Evan.